Okay, so we'll start FMP 8 using futures for hedging. Okay, just wanted to inform you. Prashali, is it okay now? Prashali is saying my voice is too low. Is it?
No, it's not okay actually. Let me connect to my headphones first.
Okay, sure. Okay. So we'll start FMP 8. Now, just want to inform all of you that today I won't be using the digital pen. Okay, so we'll just use the mouse uh, because we have tried to annotate even the places where the requirement of digital pen was there, as we always do. Okay, but we have done it a little bit more. So whatever doubts are asked, if annotation is required, I'll use my mouse also. No problem at all. Okay. So these are the learning objectives. Define and differentiate between short and long hedges and identify their appropriate uses. Then describe the arguments for and against hedging and basis. Okay, if you remember, we introduced basis and basis risk last time only. So we'll explain this part in detail, particularly in the context of hedging. Then we'll define cross hedging. Okay, and find out the minimum variance hedge ratio and hedge effectiveness as well. Then we'll compute the optimal number of futures contracts needed to hedge an exposure and calculate the tailing the hedge adjustment. Now, this tailing the hedge part, you can deal with the video for more details. So in the class, we'll just go for the formula. What formula you need to understand to solve questions regarding tailing the hedge in the exam. Okay, that's it. Explain how to use stock index futures to change the stock's portfolio's beta. And finally, how to create a long-term hedge using stack and roll strategy and describe some of the risks that arise from this strategy. Okay, so let's start. Okay, now generally there is a high correlation in price movements between the futures markets and the cash markets. Of course, we are considering the same asset. So let's say if you talk about crude oil in the cash market and crude oil in the futures market. So if the price of the crude oil in the cash market is changing, then the price of crude oil in the futures market will also change, probably by a similar amount in the same direction. Of course, direction will be same, but the amount also might be same, particularly of the near term contracts. Okay, it may be there may be some kind of differences if you consider long term contracts, but with respect to near term contracts, there is a very strong correlation. Now, futures position, it can act as a substitute for later cash transaction. Okay, this is an introduction. We will understand this part in more detail later on. What is hedge? We have seen this earlier also. Hedge is a position established to minimize the exposure to the unwanted risks. A hedge can be either a short hedge or a long hedge. Many of the participants are hedgers. So, what do hedgers do basically? Okay, no, near term is less than 1 month. I'll say anything. Okay, maximum 2 months if suppose 1 month contract is not available. Cash markets means spot markets. That's it. Currently, what is the price in the market? That's the cash market, nothing else. Normal spot market. Okay. If you want to buy it exactly right now, what is the price you have to pay? That is the meaning of cash market with that. So many of the participants are hedgers. Okay. They generally take equal and opposite position in cash and futures. Now, do you remember there was an example in the last class where we discussed about arbitrage, right? It was not hedging, it was actually arbitrage. So I told you that you will be able to understand the how part over here, but why part, why we are doing exactly this, that will be more clear when we study valuation of forwards and futures, which is going to be today in chapter number 10. Okay, so there also in case of arbitrage also, okay, it was kind of equal and it was equal and opposite position, right, to gain that riskless profit in futures and cash. So similar idea we'll see today as well. In fact, we have seen many examples in the last class regarding US Treasurer, how the US Treasurer was actually hedging the currency risk and all. What is the aim of hedgers? The aim of hedgers is to use futures markets to reduce a particular risk that they face. And what is a perfect hedge? Perfect hedge is one that completely eliminates the risk. And of perfect hedges are rare. So this is just the introduction. Let's start. Okay, now what are short and long hedges? So what is a short hedge? A short hedge or selling hedge is a hedge in which the hedger takes a short position in a contract. Okay. So it can be possible in two cases actually. Either the hedger owns the asset or the hedger is about to receive the asset. So when this is the case, when the hedger owns the asset or the hedger is about to receive the asset, okay, we say that hedger is long in the spot or cash market. The hedger is long or long in the spot or cash market. So own is very clear. Of course, it will be long in the spot market because it owns the asset. Even if it is about to receive the asset, okay, without, let's say, after some time, uh, then it is long in the spot market. So to hedge this particular position, if you are long in the spot market, so sorry, if you are long in the spot market, to hedge this position, I said we should take a opposite position in the futures market. So can you tell me what position should be taken in the futures market? Correct. We should take a short position in the futures market. Okay. So let's take an example. Let's say today is 27th of July, of course. So let's say company will receive an asset X, 100 unit of that asset X in November 2025. Yeah, got it again. In November 2025. Okay. So if suppose we have to minimize the risk of the asset price changing after webcam is on, webcam is actually off, right? I make sure that, I mean, is there any interference of the slide with the webcam for anyone? Aviank is saying webcam is distracting. Okay, 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 okay. Because I cannot see it actually. I have minimized it, so I thought maybe all the videos. Okay, but okay, okay, okay. Got it, got it. So please make sure everyone that your webcams are off. Okay, and this was surprising because if someone's webcam is on, actually everybody is able to see it, including me. I'm not able to see it actually. Nothing at all. Well, in my board, my dashboard only a blank webcam. This icon is showing nothing else with the names of the people who are unmuted. That's it. Nothing else. Okay, fine. It's clear now. Fine now. Got it. So company will receive asset X in November 2025. Okay. Now we are given that today the spot price is $55 per unit and the futures price of the November contract is given to be $54 per unit. See, what is the risk for this company? If company will receive asset X in November 2025, correct? Absolutely. The risk for this company is that the price might drop. Okay. Now, first tell me whether the company is long in the spot market or short in the spot market. Based on the scenario, it is going to receive asset X.
Long,
With
long,
respect to asset X, correct. It is
long.
long in the spot market. Okay. So if the company is long in the spot market, it means the company has to go short in futures to hedge its risk. Okay. And the risk for the company is that the price of the asset X might fall after some time. So let's say today, if it is 55, the company is worried that, when the company will receive the asset in November, the price of the asset might fall down to maybe 50, 40, 47, 48, or 45, anything like that. Okay. So the best way out for the company is to go short in the futures to lock in its price. Okay. So let's see the scenarios. Let's discuss. If the company is hedging, is hedge a good decision for the company? Let's see if the prices fluctuate. So let's take a scenario one, where spot price falls to $47 in November. Okay. In this case, the company will have to sell the asset at $47 if suppose the company did not hedge. If the company did not hedge, then the company will have to sell the asset at $47 per unit in the spot market. So this will be the revenue of the company. But since the company has since the company has hedged at $54 and the futures expired, okay, at say any price, because it is possible that as of now, even the futures price might be changing. In fact, it would be better that instead of futures, we would have taken forward, because we have all discussed that futures prices, they change every single day. They are mark to market every single day, the gain and losses. So it will not be done at once. But in for the sake of simplicity, right now, we are assuming that it will be done at once in the end. So it's better to assume forward rather than futures. Yes, Pooja Ravi Shankar, you have raised your hands. Please go ahead.
Yes, sir. So I just have a small doubt.
Yes.
Before the scenario one, we were talking about the company has a long position in November 2025, correct? So it will receive an asset. So that is a if I'm not wrong, it's a long position in November 2025. It means today in July I have a naturally short position, right?
No, no,
So
no,
should I not enter
no.
into a buy
Even
futures
even if
in?
even if that's actually a very valid point, because if you see that I've mentioned that company will receive the asset X in November 25. It's not owning it now. So the
Yeah.
intuition that, yeah, your intuition is actually valid, but as I said it very clearly in the beginning, that if you are owning it now or if you are about to receive it in the future, even then it will be treated as long in the spot market. Okay, that's the
Sorry,
idea.
can you come again?
Yeah, I said that if the company is owning now, if the company is already in
Okay.
possession, or if the company
Okay.
is about to receive in the future, okay, then also it
Okay.
is long in the spot market. So it can be a farmer also. If suppose a farmer has to harvest his or her crop after some time,
Okay.
maybe after 2 months, the farmer is not in the possession of that crop right now. Okay, but since the
Yeah, that,
farmer will harvest after some time, then the farmer will own after the harvesting is done. So the farmer also, you can say, is about to receive that corn after some time. That's the
that
idea.
is why I'm asking this question because in the video, the con example where he has to buy in the future, you have explained that because he has to buy in the future, naturally he has a short position today, and that's why we enter into a buy futures.
No,
I get what you have explained right now,
yes,
but
yes, yes. This
it's a
this
little
this idea we have to
contradictory,
use.
so I'm
Even in the
confused.
video, if you see, actually, even in the video, actually, he or she has to buy futures that just after this session, just make sure that you go through that part once again. I think there is slight confusion. It the same idea which I have used in the video, okay, has been used over here. But if at all, Pooja, if there is any kind of contradiction, please make sure that you let me know. Okay, just message on Telegram to Philip. Okay,
Yes.
and we'll just
Okay.
rectify it
I
if
will.
it is there. But finally, this idea will be the final one, whatever we are discussing in the
Understood.
class. Okay, got it?
Okay.
Okay,
Okay.
thank you, Pooja. Thank you. Yeah. Now, so if suppose we were discussing that, let's assume it's forward, okay, not futures. Let's say it is being done using a forward price, a forward contract. So since it shorted the forward contract uh, at $54, okay, and we don't need to worry about this part because the future, see, what happens is that the futures price also change, and in the end, the spot price actually becomes equal to the future price. So the future also expires at the same spot price at the end. But anyways, we are not going into that right now. To make this example simple, we are not going into that right now. We assume that everything is being done using a forward contract with another party. Okay. So the company has gone into a short forward position at $54 with another party. So since the company has already shorted the forward at $54, so what will be the gain in the forward? If you see as compared to the spot, what will be the gain from the forward position? Actually, absolutely correct. $7 per unit. Correct, Avyang? And how many units are there for that asset? 100 units, correct? So can I say that it will be 700 for the entire lot, for the entire 100 units, correct? Got
Yeah.
it? Okay. So you can clearly see that The future forward gain is something else. Now, this mechanism I'm not explaining right now. I'm going with a simpler explanation right now. Okay, I'm not using the futures contract because actually what happens, okay, now let's come to the futures part. This part is okay. If it was a forward, gain would have been simply 700, right? That is completely okay. Now, Aviyank is asking, wouldn't the company's losses double if they use futures for hedging? No, no, not at all. Even if they use futures for hedging, it's still the same. Let me come to that part now. So let me come to the futures part. See how the futures contract work. As I told you, that futures are settled every single day. So when the company has used the futures contract, they generally are never, most of the time, in fact, I should not say never, they generally, almost in more than 99% of the cases, the contract is settled by entering into an offsetted contract or the opposite position rather than, you know, rather than you can say exercising the contract and taking the delivery. So delivery hardly takes place in case of futures contract. So if it were a forward contract, then there is no problem at all. Okay. If it is a forward contract, then the idea is very simple. But if it is a futures contract, then every single day mark to market will take place. Now let's explain that scenario also. Okay. Yes, yes, exactly. That is what we have discussed. At expiry usual, futures has also expired at 47 because spot price was 47. So convergence has taken place. But now let me just come to the scenario where we are using futures. So let's assume that we are not in the futures now, not forwards. What happens in futures? You actually see what is the difference between the price of the futures contract now versus the price of the futures contract at the time when you entered into the futures. So even in futures, actually, if you see only in futures, you have actually made a gain of $700. Correct? If you offset the futures today at the final day of the contract, if you offset it, then what is happening? What is the gain in the futures? What is the gain in the futures? Is it not 700 as well in total? Yeah, $7 per unit. So $700 in total in futures. Agreed? Okay. So you have gained $700 already in the futures and you actually sell the asset in the spot market only at $4,700. Okay. Yes, Nitin, I'll unmute you. Any doubt you have? Minute. What happened? I'm not getting the option to unmute. Just a minute. But I am getting the option of ask to unmute, but not unmute. Wait, wait. Okay. Yeah, now I think you'll get the option. I think now you'll get the option, Nitin, right? Okay.
Yeah, that's fine now. Thank you, sir.
Right. You can mute yourself, and whenever you have a doubt, you can just unmute and speak. Thank you. So, as I was saying, that you entered into the futures contract at 54. Okay, you shorted it. The futures contract is also changing in value every single day. And at the end, we all know that without any doubt, towards the end, the futures price has to be equal to the spot price. So if the spot price falls to 47, the futures price will also converge to 47. Since you are in a short position in futures, you will benefit from this decrease in price. Earlier, the price was 54 for futures. Now the price is 47 for futures. So the gain in futures is actually $700. Now what you do once the asset is received, okay, for the in the context of the company example, and if you see the context of the farmer example, if the crop is harvested, the farmer actually sells the crop in the spot market only, and the differential amount of gain is made in the futures market. Okay, yes, absolutely correct, Vedant. 700 is the accumulated gain on account of daily settlement. That is why I said, to make it simple, let's start with a forward contract. So if it was a forward contract, then what would be the scenario? Then you would simply exercise the contract, okay, because forwards are mostly exercised, delivery and everything is taken, and the same asset which you have received after say 3 4 months in November, that same asset, instead of selling in the spot market, you would have directly sold to the other counterparty, okay, using the forward contract. Is the idea clear? The difference in hedging, the difference in the hedging mechanism. Is the idea clear? Avyank, you have also asked some question. Is the idea clear now? And Avyank, we are not spot and long in spot and short in future, so they are nullifying each other. No, they are nullifying each other at that point in time when you have entered. Okay, Avyank. But in the future, since the prices are changing, your futures prices at which you entered, Avyank, is the same, right? You entered the contract at 54, Avyank, correct? So that is why, since the price is changing, now they don't nullify each other. They nullify each other in the beginning, but not at a later stage because the prices are changing. Got it? Okay, fine. So is the difference clear to everyone between the mechanism of hedging using forwards and futures? Although we have explained this using futures, although the annotations are there using futures, but to start with, I use the forward part first so that you can understand it without any kind of complications. And then comes the futures into picture, because futures contract they generally are settled via offsetting, not via delivery. So that's why what you do, you get the same gain, but you get the $700 of gain in the futures position. You don't take the delivery of the contract, you still sell it at the spot market only. You don't, I'll say the counterparty actually does not take delivery in this case. So you don't sell to the counterparty. Okay, you actually sell in the spot market only, but because you are in a futures position, you have gained $700. And Vedant, you are absolutely right. It is actually the accumulated gain on account of daily. So every single day settlement is taking place. So till November, total $700 have been gained in the futures contract. Absolutely. And now, yes, absolutely correct, Vedant. Now, if someone wants to enter into the futures contract, the the futures price for that person, okay, who wants to enter into the futures contract will be not exactly 47 Vedant, but maybe close to 47. Why I'm telling you this? Because see, this contract is now about to expire. Na? This contract is now about to expire. So someone who will again use the futures contract for hedging or for speculation, maybe the December or January contract will be open. Okay, so if it's a normal market, the futures price will be slightly higher than the spot price. Agreed. So that is why, to make it consistent, if you see in this case, okay, in this case also, see, I took a slightly different price. A slightly different price. Maybe in this case, the price was a bit lower. So maybe the market was in backwardation that time. Okay. So the futures price was 54 that time, whereas the spot price was 55. Because they are not of the same duration, right? Futures spot price is for today, but futures price is of a contract for November 2025. Okay. Very good question, actually. Fine. So the net effective price is actually $5,400. Okay. So hedge protected the company from loss. So this is quite clear. So in scenario one, hedging is actually, it seems to be a very fantastic decision, a good decision. It protected the company from loss. Now let's come to another scenario. Instead of falling, the price actually rise to $59. So in this case, what will happen? The company will be able to sell the asset at $59 per unit. Okay, by mistake, per unit has been written twice over here. So I just delete it. Okay, in the spot market. So the revenue will be $5,900. So if suppose the company had not shorted, yes, Avyank, that is the scenario we're discussing right now. Exactly. We'll discuss this scenario at 59. So instead of 60, we have taken 59. We'll see what is the effective gain. Okay. So since the company, I mean, has shorted, let's first start with the simpler scenario. What if the company did not short? If the company did not short, the company would simply have sold the asset at 59 And this would be the company's revenue, $5,900. It is about to receive the asset, it receives the asset and it sells it immediately. Okay. So it gets a revenue of $5,900. Now, uh, I think Pooja, you asked, right, that in the in this previous slide that long or short, there was a confusion, right, between long and short. See, in this case,
Yes.
if suppose the company, the whole idea is this, that if you are receiving something or you are owning something, you have the liberty to sell it, right? Got it? So that is the intuition behind the long position in the spot market. So don't, I mean, this can be this can seem a little counterintuitive to you initially, because you might be feeling that, if I'm receiving it, then maybe I'm paying some price for receiving it. So how can I be in the long position, right? I'm paying for it. But the scenario is very, very clear. In any case, there has been some kind of obligation that maybe you have already performed. Okay, so let's say you are a company who's providing service to a client based in, say, Indonesia, and you have already provided the service. You are actually providing the service over the next 2 months, and the amount of, or you can say the amount that you have billed to the Indonesian client, the payment for that amount will be made after 2 months. Okay, so actually you are long in the Indonesian currency. Okay, Pooja, because you will receive it. And finally, since you are an Indian company, Pooja, it means that you cannot keep that. You may want to keep it to yourself, that is your choice. But still, ideally, what you will do when you will prepare your balance sheet, you will try to prepare it in a single currency, right? You have to make it consistent. So obviously, that Indonesian currency which you receive after some time, okay, after 2 3 months, you would like to sell it in the market and buy Indian currency for that. Correct, Pooja? Got it?
Yes.
So that is the idea. So when you are owning something or you are about to receive something, so it means that you have the liberty to sell it in the spot market at the time when you receive it. Okay. Or maybe today only if you are owning it, no problem. So in this case, the company will simply sell the asset at $59 per unit in the spot market. But what if the company had hedged? Like for in this case, we are assuming that the company has hedged, right? Since the company has shorted the futures contract at 54 and the futures now expired at $59 because they will converge, the price of futures and spot will converge, the company will actually lose how much in the futures market total? Correct, $5 per unit. So total loss is 500, right? It should not be actually negative. It should be loss is always, positive. It's if we would have written futures profit, then I would have written negative. Okay. So since it's already a loss, so it means it's a profit actually. Or else what we can do is we can erase this part and we can change this part to profit. So it's a negative profit. Both are okay. Okay, because this equation is already putting 54 first. Okay, so it's negative 500. So its futures profit is negative, which means you are at a loss. So what is the net effective price that you are getting? Can you tell me? What is the net effective price that you are getting? Net revenue, you can say. And then you can divide it by 100, no problem. What is the total net revenue from the futures and spot combined? Correct, 5400. Absolutely correct. Okay. So net effective revenue, if you see, is 5400, which translates to $54 per unit. So in this case, what happened? The price at which the company had locked 54, that is only being realized. Okay, whether it is scenario 1 or scenario 2. So in scenario 2, don't you think the company has actually missed the upside of rising prices? Yes or no? Agreed? By
Yeah.
shorting, the company has actually missed the upside of rising prices. Correct? Nitin, I think you're speaking, but your voice is not audible actually. Your mic is going up and down. Are you
Okay.
saying
No,
something?
I was just saying, yeah.
Yes, yes, correct. But it was not audible. Okay, uh, company misses the upside of rising prices. Correct. This is clear to everyone. Okay, so if this is the case, Can you tell me whether it was a good decision or not? Let's think about it. Okay, we can discuss this in the next slide, but it is very clear right now that for the first scenario, the company actually gained as compared to the spot market transaction. In this scenario, the company actually loses. Okay.
But then there was no profit, no gain, right?
Uh, but it was actually, if you see, it was in futures position, it was a loss, right? If suppose the company did not hedge, Nitin, what would be the revenue of the company? 5,900, right?
Okay.
Okay, that's the idea. But now the revenue has fallen down to 5,400 because of the hedge. So yes, correct. Ujjwal and Rambabu, absolutely correct. Even then, correct. It is a good point from risk management view, but not from profitability. Very good answer. So let's just summarize this and let's discuss final conclusion. Was the hedge a good decision or not? So obviously it depends on the company's objective. Okay, let's see the objective. And based on that, if the hedging activity was good or not. So if the objective is to protect the company from the downside of falling prices, then hedging is definitely a good decision. So from a risk management point of view, it is a very good decision. Okay, because it eliminated risk of falling prices completely. But yeah, if the objective itself was profit, then it was not a good decision. So the company gave a potential upside in scenario 2. But see, generally, in case of hedging, the objective is never profit from rising prices. So this objective is mostly not the case in case of hedging. Maybe if the company was speculating, then the objective was profit from rising prices. So if suppose that was the scenario, then entering into this contract, short contract and all, it was not a great decision because the company had to give up the potential upside.
So there can be multiple options for company to get the profit, right? I think hedging is not the only option. Hedging is mostly done to safeguard from the risk.
Absolutely correct. So that is why it is a good decision from a risk management point of view, from a hedging standpoint of view. Okay, if the objective is protection from downside only and making sure that the prices have been locked without any kind of uncertainty, then definitely hedging was a good decision. So third scenario, price certainty or planning. If suppose, see, when you are looking these two scenarios from the point of view of an individual, say farmer or a company. I mean, there are two things. In both cases, whether it's a company or a farmer, they both are more concerned with the prices, moving against them and uncertainty which is associated with that. Uncertainty is a very big factor because the company would probably want to, sacrifice some of the profits, potential profits, even because that's not realized right now. Maybe the prices move in your favor or not, they don't. The company don't doesn't know in advance, but still the company would prefer, right? If the company is preparing its balance sheet, throughout the year they are making entries and everything. Don't you think it would be better for a company to already factor in all the costs with absolute certainty? Yes or no? Okay, correct, Gauri. Company was not into speculation. Absolutely. So this is actually a good decision. This gives you certainty from a planning perspective also. Now, since the costs and revenue are known with certainty to the company, so from a price certainty as well as planning point of view, it was a very good decision. Okay, it locked in a known price at $54. So overall, hedge is a good decision if the company's goal is to eliminate uncertainty. Okay, so that is the idea. Now let's come to the opposite kind of hedge, the long hedge. The long hedge or
I
buying.
have one query.
Yes. Sorry, Parth?
Can I ask a doubt?
Absolutely, yes, yes.
So, sir, you said that the spot price was $55 and they signed a futures contract of 54.
54,
Correct.
correct.
Yeah. So, suppose in the case if they owned the asset, they were not about to receive it in November and
Mhm.
they own the asset in
Mhm.
July itself,
Mhm.
then rather than going into a futures contract of $54, why didn't they sell it in the spot market
Again,
for.
because maybe see if I own the asset, and let's say if I want to use the asset for some time without any kind of, I mean, and it's an asset, even if I use it, let's say if I can lease it also. I mean, some assets can be leased out also, right? And if I want to get some kind of profit from that lease, because maybe it's peak season for that commodity, right, for that asset, so I don't want to let go of that kind of profit and I want to sell it later. That is the idea. Got it, Parth? Clear?
Yeah, okay. And sir, can you explain futures that price adjustment in short? Like you said, daily to daily, there is some adjustment in the price.
The same thing that we discussed earlier, mark to market in the previous class. FMP 7, we discussed futures
Okay,
market where there was an example also margin accounts. Remember?
okay.
Okay,
No,
the
I haven't watched it. That's why. Okay.
okay. The same FMP 7. Just go through FMP 7. It will
Yeah.
be very clear. Don't worry. Okay,
Okay.
it
Thank
will
you.
be clear in detail. Don't worry at all.
Okay.
Okay.
Thank you.
Sir,
Yes.
just a small
Yes,
request.
Pooja.
If you can summarize this discussion as a thumb rule, saying like if the position in the future, like in this example, in the future in November 2025, the person is about to purchase the asset, right? So if you can give a summary, like a thumb rule saying, in the future, if I'm going to purchase something, then the position that I have to take in
Understood.
the
Understood. So let's do
if
one
you can
thing.
give us some
Let's
rule
give a
like that,
summary.
it will
Yeah, yeah.
be
Got it, Pooja. Got it. Absolutely. And it is actually important from the exam point of view. I think it's important, a thumb rule. So we can discuss a thumb rule just after we complete this slide also. Okay. Because we need to
okay.
understand the
Okay.
long edge also first for that. Okay.
Okay.
So let's start the long edge and then we'll give a summary. So long hedge is a hedge in which the hedger takes a long position in the contract. So what are the scenarios? What is the situation from the spot market where you have to decide that you have to take a long hedge? Okay. So if suppose you have to buy in the spot market in the future, it means you are naturally short in the spot market. Now, this again might seem very counterintuitive because just two or three slides back, I told you that if you are about to receive the asset in the future, you are actually long in the this spot market. But over here, if you are buying in the spot market in the future, I am saying that you are naturally short in the spot market. You might ask me, sir, if even if I am buying, I am still receiving it, right? That can be the first doubt in your mind. But there is a big difference. This term, you are actually buying, so you have to pay for that asset in the spot market in the future. That is important. So if you take the example of that company, the Indonesian company, you are who's your client, you're serving that company and you're performing your job, and then after some time you're receiving payment in Indonesian currency. So you're about to receive it, you're not buying Indonesian currency. So understand the difference over here. You are not buying Indonesian currency from your client. You have already performed service for your client and you are about to receive the currency. So is the idea clear? The difference between owning it right now and or sorry, the difference between receiving it later and buying it later. So there is a huge difference between them. Just like a farmer, the farmer is not going to buy the crop from the field, right? The farmer is about to receive it. He's going to harvest it. Okay. Yes. Anyone has a doubt in this? Okay, it's clear, right? Got it. Okay, so please make sure this difference is very, very clear in your mind. Okay, although once you go ahead, and you understand the concerns of the company or the person, even then you don't need to remember this idea, naturally short or long. But still, I would like you to understand this idea as well. Because see, if you consider the logic part also, that you don't want to understand whether I'm naturally short or long in the spot market. Let's say you don't want to understand this, at least you are very clear with the idea that if I have to buy something in the future, if I have to buy gold in the future, okay, let's say I have a wedding at my in my family and I am obligated to buy say some gold, say 50 grams of gold, 100 grams of gold. So in the future, so what will be my concern for, with respect to gold prices? Obviously the price of the gold may go up. Okay, so if the price of the gold may go up, what will I do in the futures market? I will lock in my buying price. Correct? Exactly. I will lock in my buying price by going long currently only. Okay. So that is why. Okay. Even if you don't use the idea of naturally short position in the spot market, it still will be very clear to you that you have to go long in the future. So logic also gives you the same result. And this relationship that if you are long, you have to take, if you are short in the spot, you have to take an opposite position in the futures, which will be long. And if you are long in the spot, you have to take an opposite position in the futures, which will be short. Okay. So logic as well as concern as well as this relationship gives you the same idea. Now, today is 27th of July 2025 and the company needs asset Y in November 2025. Now, again, I will just give you a slight hint over here that this word also, buying, needing to buy or needing it after some time. Because if you look at the context of the farmer, farmer does not need the crop. Okay. Farmer is going to receive it. It does, technically, if you see, farmer does not need it to use it for his or her own consumption. No. Farmer has to sell it. The farmer is about to harvest it after some time. He will sell it and he'll make profit from it. This company needs it in November 2025. So if there's a company, okay, which let's say is dealing in the business of say producing, I mean in the video also we have given the example of cornflakes. So if the company is dealing in the business of producing cornflakes, so the company will need raw corn after some time because maybe the current batch is already going on and the next batch will start in November 2025. So the company will need raw corn during that time. Okay. So Abhyang has given some feedback. If someone is long hedge, then it means that they are worried about the spot prices going down. No, buying hedge. If someone is buying hedge, then actually it's the opposite scenario, Abhyang. Then they are worried about the spot prices going up. Okay, Abhyang, because in the previous case, again I'll repeat the example of the Indonesian company, which was the client. Now, over there, you are not in a buying hedge. You are actually in a selling hedge. Okay, because you were worried about the price of Indonesian currency going down. Okay, so in this case, it will be worrying about the spot price going up, not down. Got it? Okay, so it's very good that you guys keep on asking these questions in between because the same point, if it is reinforced again and again, then it will be easy for you to remember it. So this company needs corn in November 2025. Now, currently, the price of corn is let's say $6 per bushel. Okay, 1 unit is 1 bushel for that. So let's say $6 per bushel, and the company has an option of going long or short, whatever the company wants to, where the price which is being obtained for the November contract is $6.2. Okay. So the spot price can change. It can change to say 6.7. It can change to 6.8. It can even change to 5.8. Okay. So we'll see what kind of situations can happen. I mean, same arguments we can see. What if the spot price changes to 6.7, guys? Will it be a good decision? Tell me. Will hedging be a good decision? Yes. Absolutely. Because if the company had not hedged, the company would have to buy at a higher price, okay, at 6.7. But the company can now execute this and the effective buying price will be 6.2. Okay. Although, again, I'm saying using futures, delivery will not take place. This contract will be settled. Okay. Sorry, there's some disturbance. Okay. Now, let me just go to Vedant's question. So Vedant has asked, would the futures price be always below or above the spot price till the time to maturity when, yes, actually, yes, it will. See, once what happens, Vedant, that generally what has been observed that for a single contract, and in fact I'll discuss this in more detail in a particular slide which is designated for this discussion, but I'm just giving you an idea over here. So what happens is that if suppose the futures price is currently higher than the spot price, then yes, there will be a directionality that it will converge to the spot price. So the directionality will be on the negative side. Okay, so if F is greater than S, F will go down and down. That is the idea, but I'll explain it in more detail. Okay, a little more on directionality as well. Now, what are the arguments for hedging? So there can be, I mean, because see, we saw a scenario where the company was missing the upside potential also. So what are the arguments for hedging? And then we'll see what are the arguments against hedging. So the first argument that is given for hedging, that most uh, non-financial companies, they lack expertise in predicting interest rates, exchange rates, and commodity prices. Okay.
Sir,
Yes.
I have a doubt in that long position. You
Mhm.
said that suppose it goes to 6.7, then it would be a good decision. But suppose if the price is below 6.2, in that case, he won't exercise the futures contract, right?
No, it's not an option. You have to exercise it. It's
Okay,
not an
so we
option. It is a commitment. So you have to exercise it. So from a hedging point of view, it would still be a good decision. But from a profitability point of view, Parth, it would not be a good
no,
decision.
no. Suppose the price goes below 6.2, like
Yeah.
5.5. So in
Yeah.
that case, it would be a loss, right?
Yeah. That's why I said from a profitability point of view, it would be a bad decision in that case
Hmm.
because it would be a loss. Correct.
Yeah,
Okay.
but in case of loss, we in the case of long, we
Mhm.
can have loss, but in case of short, we don't have loss. Like we uh, can reduce the risk or maybe eliminate the risk.
In both cases, you can have losses because in case of short also,
Mhm.
this is a loss. This is a loss.
Sir, here one doubt, sir. Can I ask?
Yes, Parth, is it clear to you?
Mhm.
It
Okay.
is a loss in both cases. I mean, if you see, if the price is moving against you,
No,
because
no, no, no. But loss in the sense like I am selling it for 54. Maybe I bought it for 50, but I sold it for 54. But the price in the futures market went up to 59. So in a way, I have gained something.
no, 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 not no, no, absolutely wrong argument. Because in the second scenario, scenario two, I told you, suppose if you did not hedge, Parth, then
Hmm.
you would have gained something actually.
Yeah.
Try and understand this point. You would have gained a lot, in fact. In that case, you would have gained the net revenue would be 5,900, and compared to
Hmm.
your initial spot price, which was 55 per unit,
Hmm.
if
Hmm.
your final spot price is 59, then definitely you have gained. Okay.
Yeah.
By directly dealing in the spot market. But
Hmm.
since you have also hedged, you are simultaneously making a loss in the futures market. Okay, so there is an absolutely realized loss in the future market. It's not that this loss is not realized. This loss is realized in the this futures market because if you see your margin account balance would have fallen by $500.
Okay.
Okay, that's the idea. Yes. Another question who was asking? There was another question
Sir,
which was being asked. Ram Babu.
Rambak,
Yes.
sir.
Yes.
Sir, one doubt, sir. In the point of in the regarding the farmer, for example, he had to be receiving the, for example, of crop in the harvesting in the November, but he failed.
Mhm.
Then that time, what is the situation, sir? What is the scenario? He
If the
failed
crop is
means
being harvested in November, then
he has to had to receive in the November. He expected,
correct.
but
Correct.
not happened because there is a uncertainty. No, then
Yeah,
that
yeah,
time he
absolutely,
already
absolutely,
contacted.
absolutely correct, absolutely correct. So, if suppose let's talk, just let's discuss this in brief in the from the point of view of the farmer also. If the farmer is about to harvest the crop in November 2025, so what is the biggest concern for the farmer? The biggest concern for the farmer is that when I harvest the crop, the price of the crop might go down. Correct?
Yes,
That
sir.
time. That is the concern, Ram Babu. Clear?
Yes, sir. No, sir. Your point is he shorted. In that concern, he shorted. Short
Correct, he
taken.
shorted.
But is the crop is not came to because due to climate or whatever it reason is not received the that point.
So you are saying that because of the market
He failed
circumstances,
to
that
crop.
drop is
Yes,
not
sir.
there, correct?
Yes, sir. Yes, sir. Yes.
Okay. So see again, if the drop is not there, as I told you that see what is the objective of the farmer? Again, we have to think about the objective also. That as a farmer, would I be hoping for extra profits, or my first concern is
No,
that
sir. My
I should not
point is
face a
he failed
loss.
to because he failed to contact, sir, because he's not having the not able to receive because he failed the crop.
I'm not very clear on what. If suppose
For
let
example,
me do
sir,
one
for
thing. Let
example,
me do
sir,
one thing.
sir,
The volume is
example,
also low at
sir,
my end. Let me increase the volume also. Wait, and then I can understand. Wait. Give me 1 minute, please. Give me 1 minute.
sir.
Yeah.
Sir, for
Yes.
example, sir, one
Now please go
farmer,
ahead. Now please go ahead.
sir, yes, sir, one farmer expected 100 tons of rice in November.
Mm-hmm. Okay.
In the context, in the rate perspective, he has short.
Okay, now I understand. Now I understand, Rambabu, why I was not able to hear because your voice is breaking a lot. Are you able to hear
Yes,
Arijit?
sir, yes, sir. Yes, sir.
No, wait, I'm asking others. Are you able to hear Rambabu properly or no?
Yes,
Properly, can you just elaborate his doubt if
I think so. I think so. What he's trying to say, suppose the farmer has to sell in November, but
Mhm.
due to climate, the crop is damaged or something else
Okay.
happens.
Yes,
Okay.
yes, sir. Yes, sir.
Okay. No, in that case, this hedging is not going to, you'll say, help the farmer much because for that, the farmer has to buy crop insurance. That will be a different thing. The hedging does not cover any kind of damage from any natural activity. So it's not an insurance. Got it, Rambabu? Clear?
Not in that context. What is this? What is the result, sir?
Then in that context, though, this entire argument does not apply actually because if the crop itself is not available to buy or sell, and you are right that if the farmer has already entered into a futures contract but the
Yes,
crop
sir.
itself is not available, then it will be a huge loss for the farmer because I think you are asking that in that context, let's say if the crop is destroyed, then what happens with the futures contract? Correct? That is what you're asking?
Yes, sir. Exact my point, sir. That
Okay,
means
got it.
yes,
So
yes.
in that case, it will be a huge loss because, of course, the farmer will have to execute the futures contract, right? There is no option for the farmer. The farmer has entered into the futures contract. The farmer has to execute the contract. Of course, there can be some regulations in some markets, maybe for these farmers, that if suppose the crop is destroyed, then there can be some regulations with respect to the delivery of the crops and as well as the settling of the futures contract. But I don't think that the futures contract will be affected in any case because the farmer will have to settle. So let me just see the scenario. Since the farmer shorted the futures, right, at $54, the futures expired at 47. So in that case, the futures contract will be settled by the farmer. Okay, in any case. So the
Yes.
farmer gains 700 from the futures without any doubt. There is no problem. But the huge loss will be again from the point of view of this part that the farmer will not be able to sell this asset, the crop at 47. So instead of the total revenue of 5400, the total revenue of the farmer will reduce to only 700. Prambabu, clear? Because
Sir,
this part
yes,
is
sir.
not coming. Got it?
Sir,
This part
here
has
my
to come
point
from
is,
crop
sir.
insurance.
Yes, here my point is that for example, risk point of view, all times is not hedging is not profitable. That I'm telling. Risk point of correct, sir. Am I
Uh,
correct or not?
from a risk point of view, I'll say that in this case, uh, we should not even consider risk point because the risk has completely shifted now. We should consider the profit point of view in this case. So in this case, actually, Ram Babu, even with the short position, even if the crop has is not available now, that is okay. But still in the futures position, the farmer has still made a profit, Rambabu, in this case. Got it?
No, hedging is purpose. Hedging is purpose of the risk management purpose, but in this context, it is not fulfilling his
No, it is not
idea.
fulfilling its purpose because of another reason. Try and understand. Not because of the hedging or non-hedging part. Because that asset itself, if it is not available, and let's say Rambabu, if the farmer had gone for crop insurance, okay, let's say, and it was in that contract that the farmer will be compensated for any kind of damage due to some kind of climate risk, let's say. In that case, the farmer is entitled to receive 4700 from the insurance company. So this 4700, okay, or any other amount which was decided by between them. So this 4700 or any other related amount will come from the insurance proceeds now, plus 700 will still be there from the futures gains. So in that case, hedging will still work.
So
Okay.
that time two contracts required. One insurance contract, second one is hedge contract.
Correct. So first is of course from the insurance contract, and this part is from the futures, the hedging part, the hedge contract. Absolutely correct. Clear now?
Thank you, sir.
Okay, great. So it was a very interesting question, I'll say. I mean, something which probably is generally not discussed in this part. What happens? Okay. So although it is not related to hedging directly, it will not be asked in the exam, but it is a very interesting perspective. Something else, right? Okay. Now I'll go back to all the questions that have been asked. Okay. Let me start with Zainab. Zainab has asked, airline is concerned that jet fuel prices will increase over the next 3 months, and it needs to purchase 1 million gallon of jet fuel at that time. This is an example of long hedge. Correct. Correct, Zena. Because the airline, this is the case, the airline has to, let me just highlight this. Yeah. So airline has to buy this in the spot market in the future. So airline has to buy jet oil in the spot market in the future. So yes, the airline will have to go for a long hedge, and airline will be said to be in a naturally short position in the spot market. Okay, because it does not have it right now. It has to buy it. It does not have it. It is not going to receive it from someone else. It has to buy it. Okay. So yeah, absolutely correct. Absolutely correct. Okay. So I think Ujjwal's questions has already been discussed. He can offset the trade. So he was talking in this context only. So Zainav asks, basically, long hedge is used when you expect to buy an asset in the future, not today, and want to protect against the rising prices in the future. Absolutely correct. Absolutely correct. Long hedge is used when you expect to buy an asset in the future and want to protect against rising prices in the future. Absolutely correct. Avyank has given a feedback, I think, on Rambabu's question. If the crop gets destroyed due to climate, wouldn't the price of the futures also rise substantially and make up for? Oh, wow, what an interesting perspective. If the crop gets destroyed due to climate, wouldn't the price of the futures also rise? Excellent perspective. Excellent perspective. Because if the crop gets destroyed from due to climate, yes, the spot prices might also increase, because it is possible that not only for that particular farmer, maybe the crop has been destroyed for many farmers, if at all it was because of climate. Yeah, if it was because of an accident, a fire that broke down, it will not affect the market prices, so it will not affect the futures prices much. But if in the general market the same thing has happened, then there is a very good chance that the spot prices will rise. Along with that, the futures prices will also rise drastically. So yeah, it's a very good point of view. Excellent. Gauri Shankar has given that 99% of the cases are not delivered, rather settled by offsetting the contract or position. Absolutely, Ravi Gauri. I said, in fact, more than 99%. Absolutely, yes. So Ujjwal has said that yes, but you are in a short position and not long, so it will be a greater loss. Okay, ignore this. Fine. Okay. So I think it's clear to everyone now. Very interesting discussion. Okay, and the whole idea is clear to everyone. Shall we proceed now to the? Oh, okay, we were going for arguments, right? We were already discussing. Great. So we'll just start the arguments. We'll resume with that. Okay. Now the company can focus on their main activities, right? If suppose you are a non-financial company, and you are the, even if suppose you are uh, the CFO also of a non-financial company, still, uh, although the CFO should have great expertise in predicting interest rates, exchange rates, and commodity prices, but it's a completely non-financial company into services, let's say. You're not very concerned with these market variables. If at all you are, let's say you don't have that much of knowledge, that much of exposure. Okay, maybe you don't even have a CFO as a non-financial company. It's possible. So the companies can focus on their main activities if they hedge, okay, without worrying about the price risks. So that is one of the arguments in favor of hedging, that the companies can avoid any kind of unpleasant surprises. Then what are the arguments against hedging? Okay. The first argument deals with hedging and shareholders. So in theory, shareholders can hedge the risks themselves, because we have seen this in the chapter capital asset pricing model diversification. In fact, this was discussed even before that, but we discussed this particular part of diversification in great detail in that chapter only, Foundations of Risk Management, chapter number 5, Capital Asset Pricing Model and Modern Portfolio Theory. So shareholders can diversify away the risks by investing across multiple companies. Okay. So this is one argument that, what is the point of hedging for the company? Let the shareholders, hedge the risks, no problem at all. But there is a problem with this argument. So in the same slide, we have also given counter arguments to this argument. What are the counter arguments? The first counter argument is that the shareholders are less informed than the management. What exactly they need to hedge, what exactly the risks are, because see, they can diversify away the market risk in general. If you see, with respect to diversification, I mean, you can diversify away, not market risk, sorry, I think I'm not correct. They can diversify away the unsystematic risk or idiosyncratic risk, the non-market risk actually. But to what extent? I mean, there is of course a limit, and even if they diversify, they can do it to some extent, but still, since they are not informed about the inherent risks inside the company, not better than the management at least, then it will become difficult for them to eliminate those risks. Okay. Absolutely, Vedant. Shareholders hedging would be more random, unstructured, and they will not be aligned to each other. Absolutely correct. So it will not be similar to all the shareholders. Absolutely. Okay. And their position may also require a small fraction of one futures contract, which is not available. This is not a very important argument, but still, it is valid. It may require, because see, it is possible that uh, uh, the the lots that they are dealing in, they might not require to go for one single lot. Maybe one single lot of, suppose we are trying to discuss this in the context of a lead company or a tin company or a nickel based company which is using nickel or producing some nickel utensils or something like that. So if you see multi commodity exchange of India, being, even in spite of being in the top 3 in terms of commodity trading for most of the commodities, still there are certain commodities, certain assets, for example lead, tin, nickel, for which it is not necessary that smaller contracts will be available. In fact, I remember, I mean, this has been since 2010. I am telling you, when I started this for the first time. At that time, there were no mini contracts in aluminum, zinc, tin, all these base metals. Okay, they introduced mini contracts after some time, but again, because of some regulations and because of the volume, sometimes the contracts were discontinued. And I think they have been introduced once again by uh, by MCX for most of the base metals. I'm not sure about copper, but I think it has been introduced. But see, it can happen that smaller contracts may not be there, and any one of the shareholders who's having a very small position in the company, that shareholder, sorry, that shareholder might actually um, have to use a very small fraction of any futures contract, which of course will not be available, right? Which will not be available. So this is one of the arguments for hedging, against hedging, but there are counter arguments as well. Okay, now let's continue with the arguments against hedging. So the two arguments which I'm discussing right now, they are related. That's why I've coupled them in a single slide. Okay. So little or no exposure. In determining the size of an exposure, it is very, very important to consider a company's complete risk profile. Okay, so if you are a gold jewelry maker, okay, so obviously gold jewelry maker, if you see most of the gold jewelry maker, they actually don't have too much of market share. Okay, there are multiple jewelry makers across a region, a city, a state. Okay, so each of them are having smaller shares. Even the bigger players in this industry, they don't capture extremely a very large percentage of market share. Okay, like we see in monopolistic competition or something like that. So in case of hedging, if you are a gold jewelry maker, in case of hedging, if the prices go up, then there is an increased benefit, and if the prices go down, this is an increased loss. Now, why this is happening? I said that I have coupled 2 points together. So why this is happening, increased benefit and increased loss, I'll explain once I discuss this next part, hedging and competitors. Because if you are a firm which is having low exposure, then of course the behavior of the market and the behavior of the competitors becomes very, very important. See, if hedging is not the norm in a certain industry, it may not make sense for one particular company which is having little exposure to choose to be different from all others. So the market has to be respected in general, I'll say. A company that does not hedge, that does hedge, can expect its profit margins to fluctuate or it becomes more volatile. Okay. So now I'll come to this part. Okay. And then I'll explain what happened actually. Suppose you are a gold jewelry maker. Okay. And see, gold is a commodity which is heavily dictated by the markets. I mean, a single player does not play a huge role, even though we generally tend to assume, uh, and this is actually a common assumption in India also, apart from other South Asian countries, I'll say that gold prices go up a lot during festive seasons. And I mean, in India, we can take the example of Diwali, where during the months of October and November, there's a lot of buying in gold, and we generally tend to assume that since there's a lot of buying, the prices are actually going up. But in reality, it does not happen that way, because even if the demand goes up by a very, very big amount, and Indians are the largest buyers of gold, they have been since, you can say, I mean, I should not say time immemorial, but yeah, since a long times, not since the time, since much before the time when modern markets were even developed or even introduced, right? Long before, say, centuries, you can say. So Indians have been the largest buyers and the largest accumulators of gold, and this is done a lot during festive seasons. Okay, so Diwali is one of those festive seasons. Obviously, there are many festive seasons where gold is bought across India. Okay, South India, you'll have different seasons where gold is bought even more than Diwali sometimes. So in those festive seasons, even though the demand is high, but still the percentage of gold, I mean, as compared to the whole gold market globally, that percentage is not that huge. So the prices of gold are actually not dictated too much because of that buying. Yeah, it is possible that because of that buying, even the institutional investors might starting investing in gold more, and then it might lead to a little push in prices. Okay, but I'll say uh, the major play which happens in gold is actually due to the activity of central banks. Okay, so yes, there is some fluctuation, some changes are there because of that demand during the festive season, but it is not there to too much influence the prices in a large way. For those of you who are interested in the factors which affect the precious metals, particularly gold, actually I wrote an article in investing.com. I think it was written in 2010, 2011 or 12. I'm not very sure. You can search for investing.com. You can go to my profile. You can definitely go for that. In fact, I'm not very sure, since it was written a long time back, 13 years ago. So I'm not very sure it will show up in the search results or not. But yeah, it's there. So if you want, a link can be shared on Telegram. Okay, you can ask for that link on Telegram. The link for that article will be shared. Okay. And interestingly, I'll say I wrote another article. I think not very. I'll say maybe 3 or 4 months around this same time. I wrote this article, the gold one. So interestingly, I am telling you, it was a very good coincidence, a pleasant coincidence, and the analysis actually worked out. So the crude oil pricing was nearing $100 that time. Uh, Okay, and I wrote this article, and based on the current circumstances, what should be the case? And after a few days, uh, the prices crashed to $80. So it was a 20% drop that time. That article is also there actually. If you see, and the comments highlight the part where the prices are actually down now. So it was very interesting. Of course, it was a very good coincidence for me also, because I had also taken some short positions in crude, and I really believed it was being highly overpriced based on the international scenario. I'll still say it was a very not a very detailed article, a very brief article, but still you'll get a decent idea of what exactly happens and how the prices can fluctuate. Yeah, sure, absolutely. Gaurav and Vedant, please just you can message on Telegram, and the link will be shared. I'll make sure because I may forget, so that's why I'm asking to message on Telegram once. Okay, you can do it in the group. In fact, it can be shared in the group so that everybody can read. That will be great. Okay. So Ujjwal is saying market will be volatile again. Yeah, yeah, absolutely. The gold market as of now, you never know. There can be a lot of volatility because of what is going on with the tariffs and the wars also. So, but what has happened also, one thing we need to understand that in the last 15, 16 years, the nature of the gold market, particularly in the context of its correlation with the other assets, other financial assets like equities and bonds, it has changed a lot. Earlier, uh, most of the investors, they always thought that if equity prices are going down, okay, thank you so much, Zainab. I think, yeah, this is the link. Absolutely correct. I think this is the link. Wow, thank you so much. Yes, yes. It was okay. It was in 2014, not 12. Sorry. I think it was I was not aware of the timeline exactly. So yeah, it was 22nd of October 2014. Factors affecting precious metals. Correct. A very brief article. Okay, and I think if you click on the profile, you'll find the second article also with respect to crude oil. Okay, you click on the profile. There's another, yeah, crude oil article was actually written in 2012. Crude oil nearing $100 is the uh, price justified right now? Yeah, so this is another article which was written on 4th of September 2012. So this was the article which I was referring to for 2012. Okay, so if you want, you can go through that. Okay. Fine. So what we were discussing that gold prices, yeah. So although out of the syllabus or out of the FRM syllabus, but it's important that we discuss these things. If yeah, just give me 1 minute. What happened to this taskbar of Zoom? Yeah, it's okay now. I'm not able to see. Yeah, the PPT. The PPT is visible, right? Yeah, got it. Uh, Okay, you studied it in your commodity prices class after 4 years in 2018. Okay, okay. That's great. That's great. Okay, fine. So I was saying that we were discussing that what is going to happen with the gold prices, what kind of speculation we can go for. And I was also talking about historic correlations and how things have changed. So over the last 15, 16 years, the scenario has changed a lot. Traditionally, the investors were always of the point of view that gold prices generally move in the opposite direction as risky assets as compared to risky assets. Okay, because gold was considered to be a traditional safe haven investment. Okay, the volatility in gold was generally a bit low, and whenever there was a crisis, people, investors, they generally tend to shed risky assets and move towards safe haven assets like dollar and gold. Okay, so that was the scenario before 2007 2008 a lot. After 2007 2008, and in fact particularly I'll say after 2010, even though 2007-8 crisis was the biggest one, but with respect to gold prices, I have seen this more after 2010. The correlations, they have actually become more positive as compared to earlier. Earlier, they moved in the opposite direction. Equity prices and gold generally moved in the opposite direction. Generally, okay, not always. So a decent positive correlation was there. Of course, in the long run, both of them are going up since a long time. But generally, when the equity prices were going up, there was a phase that, at that time, gold prices will go down, because it makes sense, right? If you are actually pulling off your money from risky assets like equities, then you would want to put your money in safe haven investments like bonds, U.S. treasuries, the gold, silver, all these precious metals. So that was considered to be a traditional safe haven investment. But now, in the last 15 years, things have changed a lot. The correlation has become much more positive, and there is a very clear cut observation that and especially this is true for price crashes. This is more true for price crashes, that if equity prices are going down, if the risky assets are going down, then gold also has gone down together multiple times in the last 15 years. So this is one of the observations. Now we are seeing cryptocurrency is not showing a very defined correlation with the markets right now. We don't know as of now. We have seen very erratic behavior in the crypto market as compared, in the context of correlation. Sometimes the correlation becomes positive, sometimes the correlation becomes heavily negative. So in fact, you might be noticing, those of you who are into crypto, in the last 1 month again crypto has started to bounce back, right? Last 1 month, massive rise in crypto. There are multiple new coins which have been launched. In fact, Best Wallet has built a great community. Although yesterday, in CoinSwitch, Best Wallet was actually they banned it they in fact prohibited. I'll not say banned. Banned is the wrong word. They prohibited a buy transaction. Only sell transactions were being permitted in CoinSwitch for Best Wallet. So there are many such coins which have actually come into the picture, and Bitcoin, Ethereum, Ripple, Binance Coin, all of them in the last 1 month they are actually going up a little. Okay, but the as you know, the crypto markets are, since this so much volatile, because of that volatility also, even to predict the correlation, actually it becomes a very challenging job. Okay, so let's come back to this example of gold jewelry maker, that if suppose the gold jewelry maker hedges the price of gold where competitors are not doing it. Competitors are not hedging the price of gold, so the market is completely open. The market actually behaves in that way where if the price of gold goes up, raw gold, commodity which is being supplied to the, I'll not say raw gold, maybe processed gold, which comes to the makers. So if the price of gold goes up, then by default, since there is no hedging between the competitors, among the competitors and in the market in general, then by default the price of jewelry will also go up. Do you agree or not? If the price of gold bars or any kind of even uh, the mined gold is going up, the price of jewelry will also go up. So the competitors, the industry behaves like this only. But there is one gold jewelry maker who decides to hedge. Okay, so if the prices go up, then there is an increased benefit for that gold jewelry maker. Why? Because the increased benefit comes from the part that this jewelry maker hedged the price of the input. So the price of the input did not change for this gold jewelry maker, because even though the market price of gold have gone up, for this gold jewelry maker, the buying price is actually low. Okay, or constant at least. But since, because of market fluctuations, since the price of jewelry also has increased, it means that this maker, although buying at a lower price, buying the input at lower price, is selling the output at a higher price. So that is why we say increased benefit, double benefit you can say. But if the prices go down, then there is an increased loss. Because in this case, the problem is that the gold jewelry maker is actually buying input at a higher price, because in the market the price of gold has gone down. But can the gold jewelry maker sell the jewelry at a higher price than market? Is it possible? Will the customers come to this jewelry maker? Because obviously no, absolutely. They will not come to this jewelry maker. So this jewelry maker, because of the nature of this industry, does not have any leverage to sell the outputs at higher prices. There is no differentiation, product differentiation as such, right? In terms of quality, of course, there may be brand value. There may be, of course, people want to move to go to higher brands only for, buying gold, so that they can be sure that there is no, the product is pure, whatever is being promised is being delivered. But still, even the biggest players, they don't have that liberty to sell it at a higher price. They may alter their making charges to increase their profits. That's it. That is the only level that can happen. The only level of, you can say, change that can happen in case of jewelry. But the amount, because of the gold part, it cannot change. So in this case, because of hedging, there is a possibility of increased loss. And a company that does hedge will expect its profit margins to fluctuate. So sometimes benefit is more, sometimes loss is more. So obviously it is more volatile. But if the company did not hedge, so again, if the prices rise, profits will be stable, because inputs price are rising, output prices will also rise. Gold prices rise, jewelry prices rises. So no problem, profit is stable. In the second case also, gold prices decrease, jewelry prices decrease, profit is stable. So that is why this is also one of the arguments against hedging. Okay, that the profits actually become more volatile if you hedge. Another argument, of course, hedging can
Sir,
lose money. Yes, please, Brashali.
sir, yeah, please, can you come up again with the second example where no hedging is
Yes, yes, yes. Suppose, Brashali, if the gold jewelry maker does not hedge, okay. If the price of the gold goes up, we see the daily prices of gold regularly, right? We everyone has that information, right? So if the prices of uh, gold are increasing, and today, let's say, Brashali, you have to buy jewelry, you go to this any store. So don't you think the same price rise will be reflected in the jewelry also? Correct, Vrishali?
Yes, sir.
Okay. And if the prices of gold decrease, and if you go today, you find that okay, fine, the prices have decreased. Let me just buy the gold today. So if you go today, don't you think that same price decrease will also be reflected in the price of jewelry also? Of course, the making charges will be same, but the price will be reduced. Correct?
True. Yes, sir.
Okay, so that is why for the jewelry maker, the profit is still stable, right? So input price is increasing, output. So the jewelry maker is not having to compensate for this price loss or price rise, because the entire the input prices as well as output prices for the jewelry maker are same. So is the idea clear?
Sure, sir.
Okay, yeah. And again, these work more in the medium term, because in the ultra short term, since the input has already been bought, so in the ultra short term, the profits will be fluctuating. So I'm not considering that. I'm considering in the medium to long term, the profits are more volatile in case of hedging and less volatile in case of no hedging. So this is the same argument that we have discussed over and over and over again. Nitin is saying gold price is regulated centrally. No, no, no. Gold price is not regulated centrally. Gold prices are purely based on supply and demand. Okay. Market manipulation can happen sometimes, but it is actually very rare in gold. There is no regulation in terms of prices, because the prices, as I said, they are mostly dictated by the bigger actions of central banks all across the world. Now when I say actions of central banks, now if you go to that article which I had written, it is mentioned what kind of actions I'm talking about. Basically, now recently, Nitin, China central bank, let me just check if this news is correct or not. If I'm, according to me, my information as far as I'm concerned, I think China central bank in the last couple of years, it has hoarded a lot of gold. Even Japanese central bank, they did actually. Let me just check. They have hoarded a lot of gold. So let us search for central bank activities with respect to gold. So is it visible, the browser? Is the browser visible to everyone? Okay. So let me just open that article which Zainab had shared, my article, and then I'll just show you the action of central bank, and then we'll see the recent news. So this was the article. Okay. And central bank activities. See. So as central banks diversify their reserves away from paper currencies towards gold, its price increases. Quantitative easing and increased global money supply by central bank also devalues paper currencies, which further drives the price of gold. Okay. So this is also something. Now let's go to China. Okay. China central bank gold. China's central bank buys gold for the seventh straight month. Yeah, so it is actually holding a lot of gold. Lot of gold. Okay. Yes, I think an article has been shared by Nitin also. Yes, same article I've opened. Correct, Nitin. So China's central bank added gold to its reserve for the seventh straight month. And have you seen the amount of hike that has happened in the gold in the last few months? Have you guys noticed it?
Yeah,
Massive
of
increase,
course.
right? Yeah, massive
Yeah,
increase from last year, August, right? Massive increase. So you can see how much of gold reserves they are having. Earlier it was 73.77 million ounces, and now it is 73.83 million. Okay, so they are continuously doing it. Central, even the Reserve Bank of India has, I think, hoarded gold. I think in the last few months, there were activities of Reserve Bank of India also. So you can just check those activities. Okay, fine. Okay, so this was the article I was referring to, and this is the second article in 2012. Okay. So yeah, so they have been up and all these things I wrote, and something happened after that. So it's a longer article as compared to the other one. I think there were comments. Yeah. So yeah, the prices fell down, fell below 80. So from 89, after writing the article, the prices were down 11% very soon. But again, it was of course a good coincidence for me that the analysis was kind of spot on that time. So I'll just share the slide once again. Is the slide visible now? Okay. So
Yes, sir.
Ram Babu has asked jewelry makers for hedging options. Again, it depends on the objective, Ram Babu. I'll not say they are better. I'll say they should not. For jewelry makers, they should not hedge the price of gold because it will lead to more volatile profits. Okay, it's better not to hedge. But yeah, but again, if the scenario, I mean, if your assessment, your perception is very different, you are very sure that the prices of gold will increase, then it makes sense, Ram Babu. So you have to be spot on in your analysis in for
No,
the next
sir,
6 months.
my opinion is instead of futures, it is options are better option to hedging the jewelry makers in
There is
Middle
only
East.
one problem in that, Rambabu. You are absolutely right. See, options are will be better because if the prices go down, then there is no problem. But again, there is a lot of premium which is associated with options, right?
Yes,
So they
sir.
have to pay a lot of premium. So futures contract, if you enter into them, they don't have an inherent cost associated to them. But if the jewelry makers use options to hedge, so if suppose prices move in their favor, they would not like to exercise those options, right? Okay, and then the options will expire worthless, which will lead to a loss in premium. So even that can dent your profits. Options, that is also a problem. So there's always a trade-off between futures and options with respect to this premium. Okay, so this is the same argument that we have given earlier. So I'll not go into the same argument again. Now let's come to basis risk, and I'll address Parth's question also. I think Parth, you had asked, right, that the directionality, or Vedant. Vedant had asked regarding the directionality, if I'm not wrong. Correct? Yes. So perfect hedges are not easy to implement. We have different asset contracts that are available because, as I said in the last class also, maybe airline company wants to hedge jet oil prices, but in the markets, jet oil is not even available, and right, so futures contract is not available for jet oil. So that is a problem. There is a lot of uncertainty with respect to time. We can take the farmer example also. The farmer cannot be 100% sure that okay, I'll harvest the crop in this time slot, maybe 2 or 3 days time slot only on a particular weekend, or even for 7 days. Even if the farmer extends this time slot, it can be done within say one out of any 7 days. Even that cannot be sure because of the changes in climate, because of the availability of resources. Okay, there is a lot of uncertainty with respect to time. So the exact hedge duration may not be known. Okay. Then another problem is, of course, that the futures contract has to be closed out before delivery. So if suppose the farmer thinks that okay, I'm not very sure about the date, but yeah, still let me think. Maybe I will harvest this in the last 15 days of October. This is a particular crop which, when in its in most, you can say most likely, it can be harvested in the 15 days. That is what the farmer feel, last 15 days of October. But maybe the contract is not available for that, for last day of October. Maybe the contract is available for say 25th of October, and the farmer, when he thinks that okay, he has to now harvest the crop on 25th, on or before 25th, finally he feels that no, the crops are still not ready, let me give them 5 or 10 another days. So it is possible that the futures contract will have to be closed before delivery. So the existence of any of these conditions gives rise to what is called as basis risk. Okay, fine. So what is basis? Basis is equal to spot price minus futures price. In fact, many in many books, basis can also be written as futures minus spot, but most of the books use this convention: spot price minus futures. Okay. So basis is equal to 0 when spot price is equal to futures price, and the change in basis over the hedge horizon is known as basis risk. So let's see the graph over here, how the prices actually change. So let's say this is the spot price. Okay. And this is your futures price. So you have positive basis over here. Clearly you have positive basis, right? Because spot minus futures is positive, correct? Okay. But let's say this is the spot price, the green one. In this case, spot minus futures is negative. So this is the negative basis. Now coming to Vedant's question regarding directionality. So you can clearly see that if futures price is below spot price, then they will move in such a direction that they converge it. But there has to be some kind of directionality most of the time, if not always. You can see over here. In fact, if spot prices are going down at a very rapid pace, then to converge, there can be only one option is possible. So depending upon the spot price, the futures price will also go down. But since initially the futures was much greater than spot, that's why the speed or the rate of change of futures price in the negative direction or in the down direction will be much less. This is less steeper as compared to this because this was already very high. This has to go to this point. Futures is not that high, so it has to go a little, you can say, of course, in the negative direction only, but a little slow. So this is the directionality. But yeah, one thing which I want to discuss, because when you asked this question, Vedant, I thought that, okay, can we think of directionality in these terms? Is it possible that can this happen? Are you getting my point, what I'm trying to say? Yes. So can suddenly the futures price go up? It can even cross the spot and then again come down below the spot. And finally, they will converge. No problem at all. Right? Yes, this graph is from the long perspective, long position perspective. Is that correct? No, 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 no. Sorry, sorry, sorry. This graph is from a market perspective, actually, not from a long position perspective. Because whether it is a long or short position, we are not concerned about that actually. We are concerned about the market prices of futures and market prices of spot. That's it. There is no long and short as such. Okay, that's it. So can this happen? Now, this is something which is interesting because just let me just click on the, yeah.
Sir, I have a question.
Yes, yes.
What is a future price?
Futures price. Let me open the browser. But we discussed. Parth, you've not watched the FMP 7 partner till
Yeah,
now.
yeah,
You
yeah.
have to watch it first. Otherwise, it
Okay.
will not be clear. Okay, so make sure that you
Because
watch
what I had in mind, no, so future price is some price which we have decided in future contract for which we will buy or sell.
Actually, that is more applicable to forward contracts. Okay, so that is why you have to
Okay.
understand the mechanism of futures. It will be very
Uh,
clear. Don't worry at all.
so sir, futures contract and forward contracts are different, right?
Yes, they are different, but the properties of both of
Mhm.
them are almost same, almost, except for
Okay.
the thing that, of course, there are differences in
Hmm.
terms of their characteristics, but the properties in terms of their price movement, they will not be different.
So
They
in
will be
forward, what is there that like in future, like after 2 months, I am going to buy it for $10, or maybe I'm going to sell it for $10. So it is a fixed price,
It is
ten
a
dollars.
fixed price. Actually, the same logic works in futures also, but the
Hmm.
settlement mechanism is different. That's why I'm saying watch the complete video. Everything will be clear. Don't
And
worry.
sir, both the future as well as forward, both are mandatory, right? We have to
Both are,
exercise them.
yes, both are forward commitments. You can call them as commitments.
Hmm.
Okay. Like
Okay, got it.
for options, you have a choice. So
Hmm.
options are similar to a contingent claim. That's why they are known as contingent
Hmm.
claim. Just like an
Hmm.
insurance policy. If there is a contingency, only then they
Hmm.
will be exercised. Otherwise, they are not
Okay.
exercised. So you have a choice.
Okay.
In this
Okay.
case, there is no choice. Okay.
Hmm. Okay. Okay.
Yeah.
Got it. Got it.
Okay.
Thank you.
So, and that is why when Ram Babu was asking this question, what will happen when the crops get destroyed? In that, the forward market or futures market, the farmer has no choice. He has to he has to honor the obligation. No choice at all. Okay, so that is completely a forward commitment. So I was saying that is it possible that the graph will move like this? This is something very interesting, and I don't think this might have been observed Even if it has been observed, it will be very, very, very rare. I'm telling you why. See, because when we talk about the futures price, we are considering a single contract. See, it is possible that if there are multiple contracts, then maybe one of the contracts is, say, above and one of the contracts is below the spot. Even that is possible. Okay. Because let's take an example of natural gas, right? We took an example of natural gas last time. And currently, we are in July, right? So let's assume, for the sake of simplicity, that we have two contracts which are available. One of them is a January contract, okay, and the other contract is next year April contract. Let's assume that, or next year March contract. So two contracts are available. One of them, let's say December, not January. Let's say this year December contract and next year March contract. Two contracts are available right now. Natural gas, and I'm talking about the US market. Okay. Now, natural gas is heavily used for heating purposes in the winter season in the United States. Okay. So let's say the weather experts predict that this year it's going to be a very, very harsh winter, and the temperatures in December will be much lower than normal. Okay, so if the normal temperatures uh, usually are, say, on an average, let's say if the minimum temperature goes down to even zero, this year there is a possibility that even in December, early starting from early December, the temperatures might go down and they might even go to some negative level by the mid of December. That is a prediction. Okay. So it means that the market will already anticipate that there might be a massive increase in demand for heating purposes in December in the United States. So currently, based on the spot price, whatever is the spot price, we can almost be sure, or we can anticipate this, that the current December's futures contract will be actually be at a higher price than the current spot price. Okay. Then it is also predicted that by March, the weather will go down to absolutely normal, though no surprises whatsoever, and the heating demand will reduce drastically. And maybe because of some other activity, also, some other usage of natural gas will also go down in March. That is also known to us. In that case, it is possible that another contract of natural gas, that is the March contract, may have a lesser price as compared to the current spot price. That is possible. Okay, Vedant. So if we talk about different contracts, then you might say that some is one of the contracts is up and the other is down. But the same contract, it will be very rare that the same contract will cross the spot and then again come down. Okay. Now, Vedant, you're asking the gain and loss would be the area between the spot. No, no, no. No, actually, area, I'll tell you mathematically, symbolically, a lot of things, because that argument holds very well in economics, where you have, these curves, the demand and supply curve. And when you have a lot of insufficiencies in the market, then the losses are actually, they can actually be calibrated and they can be calculated based on the area of some regions. In this case, since the parameters, one of the parameters is time. Okay. In that case, if you remember the parameters in most of the economics graph, those of you who have studied economics, what are the parameters of these graphs, the supply and the demand graphs? What are the x and y axis? Can you remind me? Anyone who has an economics background? X and y axis of supply and demand graphs, supply and demand curves. What are the parameters? Is time a part of those parameters? Is time anywhere in the x or y axis in supply and demand curve? Anyone who has any background of economics? Then if you're saying something, it's not audible. Can you just speak a bit louder? Very good, Bukola. It is price and quantity. So if you want to calculate loss and profit, price and quantity are two very good parameters, right? They will actually give you mathematically also that graph will make, it will become consistent to the figure that you get by calculation from the graph area. But in this case, what kind of loss? It might be symbolic. Understood? Yes, correct, correct, correct. Absolutely, Arijit. And if you invert it, there is something also called as the inverse demand curve, right? Because the demand function, if you remember, the demand function is not represented by the demand curve. Actually, it is represented by the inverse curve, right? Anyways, those who don't have background don't need to worry about that because we are not studying that right now. Okay, so in this case, Vedant, how will we even represent that loss in the form of area? We can do it symbolically. That's okay. But mathematically, it will not be consistent with the exact area. Got it, Vedant? Okay, so it's a very technical point, in fact, an interesting point that you have raised, and that is why I say, you might be tempted to believe that if you're studying it for the first time, you don't analyze the mathematics properly. You'll say, "Huh, it's this area." You'll shade and you'll say, "Huh, this is the area," which is not wrong. But the problem is that we need to understand that it can be symbolic, but we need to understand the mathematics part also, whether it is exact or not. Okay, so this change in basis over the hedge horizon is termed as basis risk. An increase in the basis is known as the strengthening of the basis, whereas a decrease in the basis is known as the weakening of the basis. Now, there is one point which has been explained in the main video using an example. Now, in the video in this class, I'm not going to repeat that example, but I'm going to highlight the main points from that particular example because that is what is important from the exam point of view. So this part, please go through yourself. I've added this separately in the PDF that for a short futures position, if the basis strengthens, the hedger's position actually improve. And if sorry, if the basis weakens, hedger's position actually worsens. How and why? Look at that example once, okay, in the video if you want the how and why part. It's a very interesting example.
Sir, what is the hedge horizon in the graph?
Hedge horizon is actually, it is not dependent on this part. See, again, it's a very good question that when you see this graph, you might feel that, okay, this is your hedge horizon from this point, starting point to this point where the futures is ending. Not necessary. It is not necessary. Maybe the futures contract is about to, the last date of the futures contract is, let's say, 10th of November 2025. But you think that you will be able to harvest your crop by 28th of October or 30th of October 2025 as the days are approaching. So your hedge horizon will be from now up to the harvesting date because that will be the date when you will close your futures contract. Clear, Parth? So from today
Okay.
until the point of time you want to execute the
And
idea
suppose if
get the
the
crop or
suppose
get
if
the
the futures contract is going to expire on 10th of November, but I expect that the harvesting may take longer time.
then the hedge horizon will be longer and we'll see this exact case what to do in those cases. That example has also been discussed, okay, just after a few slides. Okay, now this is a very very important slide. As I said, very very important. Please make sure that you understand the example. Even if that is you don't remember it, that's okay, at least go through it once. But this is the slide which is important from the exam point of view. Okay, what exactly happens, why and how? Go through that example if you want to understand the why and how part. Now coming to your question part, as I told you that we'll discuss this right now. Before that, I'll just go to two questions which have been asked.
So, sir,
Yes,
just a second. That
yes,
hedge horizon is a time period.
correct. It's a time.
Okay,
Okay.
okay, got it.
Yeah. So I'll start with Nitin's question. Here is the basis same as what RBI controls? No, it is not the same. That is completely different. Okay, those basis points are in the context of interest rates. This basis again, it is mostly about demand and supply. Okay, Nitin. Next question, Ujwal. That basis, yes, exactly, Ujwal. That basis is related to interest rates. Yeah, that is what I was saying. So Vedanta has asked for the short position, the futures price The futures price line would be above the spot price line. No, 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 no. Not necessary. Again, I'm saying the line between spot and futures will be decided by the market. The forces which I just discussed here for natural gas, whether you are in a short position or long position, the basis is positive or negative is not decided by that, Vedant. It is still the same. This diagram is exactly the same for the long as well as the short position. The only difference is that one of them will have a profit, the other will have a loss. That's the only difference. Okay. Got it? Okay, so Ujjwal is asking basis increase is equal to spot becoming higher than the than future, vice versa for basis decrease weak. Don't say spot becoming higher than the future always. Say, although your logic is not wrong, but we can put it more precisely because yes, if spot is higher than future, basis will be positive. But if that positive basis also has to increase, then Ujjwal, there can be two situations. Either the spot will increase or the future will decrease. Even in both cases, basis can increase, right? Because basis is the difference. Okay, Ujjwal. So the difference, how will the basis increase? If this difference has to increase, then either this will increase or this will decrease. The basis will increase. Or else, if this is increasing and this is also increasing, then the rate of increase of this should be higher as compared to the rate of increase of this. Even in that case, the basis will increase. Okay, Ujjwal. Okay, so all these things can play their own roles in the context of basis increasing or decreasing. Okay, now let's come to this part of cross hedging where we'll see the hedge horizon also and what problems we can have in case of the futures contract expiring earlier or later than the hedge horizon. So the asset that gives rise to the hedges exposure is sometimes different from the asset underlying the futures contract, just like airline company and jet oil futures. Uh, so it's not available, jet oil futures. So since the asset is different, so we have to use some other asset to go for the hedge. Before I continue, Abhyank has asked, can spot and futures move in opposite direction to each other? Normally, yes, yes, absolutely. They generally don't move in opposite directions. Generally, they don't move in opposite directions. But the problem is that, see, what are we considering? When we are considering basis risk, we are also considering that there can be also a good chance that the two assets can be different. But let's say if they are same, if the assets are same, then generally they will move in the same direction only. Okay, and that is why I said, see, this thing is not possible generally. This is not observed because for this to happen, they have to consistently move in the opposite direction. Okay, but yeah, one thing can happen. One thing can happen, Avyang, that if suppose because of some situation the futures price is something like this, because in this case you see generally all of them are going down, so they are moving together, they are always going down in the same direction. But let's say there are some abnormalities like this, sometimes it happens, again it will be rare. So I'm using my mouse, okay, so the diagram will not be that great. So if suppose this is the case that you have a futures contract over here, okay, and you have a spot over here. So generally they both will come down and they will meet over here. Okay. But sometimes it is possible that spot will go up like this and futures will go down like this. So finally they have to converge. So this was an abnormality that futures price was abruptly high in the beginning because maybe the market anticipated that some event is supposed to happen in the next 2 months. So that's why the 2 month futures contract is abruptly high. But gradually, as you move ahead, they will converge together. Got it, Avyank? Yes, Gauri will explain it. Everything has been discussed in detail. Cross hedging, in fact, we just started. Okay. Yes, yes, yes. Absolutely. They will be correlated, but yeah, this if this is the case in the beginning, there's a huge gap, then definitely one of them will go down, the other will go up. Okay, it can happen. Not a big deal in this, but generally this is the case. So this is known as cross hedging, and the contract which is used for hedging should be chosen considering the following points. So two points have to be understood. That the delivery month that is as close as possible to but later than the hedge horizon. Okay. Next, when there is no futures contract on the asset being hedged, the contract whose futures price is most highly correlated with the asset price is chosen. Now let's take an example. Okay. So we'll discuss, Gauri, a lot of examples with respect to cross hedging, and we'll see many scenarios, not only in these slides, but in subsequent slides also. So Arijit has asked, yes, they are a part of the syllabus and they have been discussed. Yes, actually, from the learning objective, they have actually modified it a little, but still they are a part of the syllabus. Okay, although the details have been omitted now. So let's take an example of, and we will discuss, okay, it's there in the main video also, and we'll also discuss in brief. I think we have discussed back normal. I'll just see if we'll discuss it today or in the next chapter, next to next. So let's say you have an airline company which wants to buy jet oil on 5th of September 2025. Okay. So Parth, this is your hedge duration or hedge horizon. Okay. It does not depend on the future contract right now, whatever is available or not. So the duration basically up to which you want to hedge, that is your hedge duration. Okay. Now you find that
Sir,
there,
can you repeat?
yes, yeah, I said that if suppose the airline company has to buy jet oil on 5th of September 2025. So starting from today, and it is known to the airline company that it will be bought on 5th of September. So this is your hedge horizon actually. If you want to enter into a futures contract today to hedge this risk, then from today, from the day where you enter the future contract up to the time where you have to buy the jet oil, that
In
is
case of buying.
in case of buying. In case of selling
Huh.
also, if suppose a farmer is sure that he will sell this crop, he or she will sell this crop on or around 25th of September, then
Hmm.
in case of selling also the hedge duration will be the same till 25th of September. Okay.
Okay, so the example which you have given in the last slide, like the futures contract is ending on 10th of November, but he is harvesting on 28th of October.
October. So
So,
20 till 28th October is your hedge horizon.
acha, so not till 10th of November.
No. So that's why I said if this date is important. As of now, we are not discussing futures contract. As of now, we are only discussing the time where you have to execute the transaction, okay, or execute the process, okay. That is your hedge duration. Now,
Okay.
you go to the futures market and you see that there are two types of oil which are available, oil A and oil B. Both are not jet oil, okay, because jet oil is not available. Now, and of course, both of them, oil A as well as oil B, both of them are having two maturities, 28th September and 31st August. Both of them are having two expiration dates. So these two are the expiration dates available for oil A as well as oil B, both of them. Now, let's do one thing. Let's first consider uh, the second point first. Okay, second point. So first, let's discuss the correlation. The correlation of oil A with jet oil is 0.89. Okay. And the correlation of oil B with jet oil is 0.52. Which oil should be used for hedging? Oil A or B?
A.
A. Obviously A, correct? So because the correlation is higher. So we eliminate oil B altogether. We will not use oil B. Next question. Now let's come to the maturity of the contract, which one we should choose. So the first point states that the delivery month that is as close as possible to, but later than the end of the life of the hedge is chosen. As close as possible to, but later than the life of the hedge. So if you see the dates which are available, if you see the dates, you will find that 31st August is actually closer to 5th of September as compared to 28th. But the problem is that 31st is not later than 5th of September. So even though 31st August is actually closer, you will do not use this contract and you will use this contract because it has to be later than the end of the life of the hedge. That is almost certain. Okay. So now priority, that this is a very technical question, Vedant, uh, and it's actually very difficult to evaluate. You have to be very, I'll say, you have to perform your calculations clearly, and I think it will be better that institutional investors think about this kind of priority. I don't think farmers should think this kind of priority. Farmer should simply think that uh, in terms of why I'm saying priority, because in this case it's very clear, 0.89, 0.52, it's very clear. So yeah, in this case definitely there is no discussion that oil A will be used. Okay, but
Sir, here
let
one
us
doubt,
say
sir, can I ask? But
yes.
the dates you have to choose accordingly long and short, no, sir, because long is one type of data you have to select and the short is one type of data you have to select.
No, no, no. Whether it is long or short, the date being chosen will be dictated by this principle only. It will not make any difference. I'll give you an example why it will not make a difference, Ram. Because see, whether it's an airline company which has to buy oil or whether it's a farmer who has to sell his or her crop, okay, the process will be executed. Let's say the dates are same. Let's say the farmer will harvest the crop by 5th of September and the airline company has to buy on 5th of September only. These are the future contracts which are available. So if you are long, obviously if you want to buy, obviously you will go long in the futures contract. And if you have to sell, you will go short in the futures contract. The dates will be dictated again by this principle. It will not matter. So even the farmer will enter into this contract, even the jet oil company will enter into this contract.
Understood, sir. Thank you.
Okay. Why this will happen? Okay, first I'm just addressing the point that I was discussing with Vedant with respect to priority. See, in this case, it's not a big deal for anyone because there's so much of difference in correlation that you can easily say that let's give priority to first correlation and then let's see what dates we have to use. But then if the correlations are very, very close, then you have to exactly see that if there is only one day which is left, say instead of the difference between this day and this day being 5 or 6 days, let's say you have a contract for 4th of September also, then what you will do? The bigger player should think about this also. Then maybe you should give more priority to expiration date. You should think about expiration date first. Okay. So this is how there will be a trade-off, of course, but the calculations will be a very, very complicated. But as a rule of thumb, even if you uh, don't want to decide on that and you don't want to make it too complicated, then obviously we'll go with this first principle and then yeah, we'll see. We'll think about this first. Okay, okay. What kind of correlation we are looking for? So let's first eliminate the other commodity because of the correlation part. Whichever is having higher correlation, I'll go with that. So maybe you are asking that. Yes, yes, absolutely, absolutely. So see, why I was saying this that this example is very simple, right? It is a simpler example. So in this case, even with priorities, it doesn't matter. Even if you give dates the priority, it won't matter because both the contracts are having the same expiration date. So in this case, it's not a problem. What if, Vedant, there comes a scenario where oil A, which is having a correlation of 0.89, has a maturity date of 28th of September, but there is another oil B which is having a correlation of 0.86, let's say, and it is having an expiration date of 4th of September. And it is having another expiration date on 4th of August. So it is not having the same expiration date at all. So it can be complicated in that case, right? What will you choose then? Okay. So you are asking, could the difference in the levels of the price of the main asset, which is unavailable versus that of the other, which are there matter? Yes, it matters. It matters actually. And that's why the calculations will become much more complicated. The dates will also start to matter. the correlations will also start to matter. Even the price will start to matter sometimes. Okay. But again, since it is very rare, I'm telling you that there will be commodities for which there the correlations will be very very close. For example, if you're considering jet oil and you want to go to the market for hedging, it is very very rare that you will find two different varieties of oil being traded in the futures market which are having very very close correlations also, and the dates are something like this. One is 4th of September, the other is 28th of September. It will be difficult, yes. Okay, yes. I'll not
4th
say
of
a
September,
composite
6th of
formula can.
September,
I think
sir.
it has to be
Sir,
subjective, Vedant. I don't think a composite formula can be created. I think it has to be subjective, but yes, but by using some kind of mathematics behind it, yes.
sir, 4th of September, 6th of September, sir, because later date, no, sir, end of the day.
That is what I am saying to Vedant. That what if you have a commodity which may have even a higher correlation, but its date is actually 4th of September, then there will be a trade-off. That's why I said this should be in the minds of only very, very big institutional investors. Otherwise, we'll keep the scenario simple. We will make sure that we adhere to this principle. So, from the point of view of the exam, Ram, this is what you have to follow. Exactly. The date should be later than the life of the hedge. Okay, Ram?
Yes, sir, thank you.
Yeah, so that was a very complicated case that we were discussing. Okay, that where if such kind of scenarios come, then what we can do. Okay, now Gauri and Vedant again addressing to the question which has more weightage, expiration date or correlation. Actually, if you see, it does not matter. If you decide first by using expiration date, okay, it's okay. Let's go for the first point first. The delivery month that is as close as possible to, but later than the life of the hedge. So let's first decide based on dates. So what we do, we first decide the date. So the date will be definitely the later one. So 28th one we'll pick. So this is the date now we have picked. We have eliminated this date. Now we'll see correlation. So you can give equal priority to anyone, it will not matter, or higher priority to the date or this correlation. It won't matter in simple situations like this. Understood? But if the scenario becomes very, very, very complicated, which will not be the case in the FRM exam, and even in the case of retail investors, even in the case of farmers, even in the case of small institutional investors, it will not be complicated. But when there's a lot of money involved, big money, even small micro dollars also, even cents also can make a difference because of the volume of the trade, volume of the hedge. Okay, that's why. Okay, so Ujwal is asking expiration date. Okay, Ujwal has given a feedback. Expiration date is important as you would need to be completely hedged and not take on any risk as the price will near to maturity. See, again, I'm saying both are important. And priority does not matter because, see, in any case, if you have chosen date, let's say, Ujwal, you go with the date first. Will you, after choosing the date, obviously, you will consider the correlation also, right? You will not choose this one. So it means date was also important, correlation was also important. In this case, in fact, if you see equally important, both the rules have to be equally followed. Got it? Agreed? Okay, great. I think now
Sir,
if
I had a
if
query.
everyone, yes, Parth.
Uh, I understood the point. The delivery month should be as close and maybe later. But
Mhm.
why is it so?
Because if suppose the hedge is closing on 31st of August, if you decide that, okay, even if I am going to, if the farmer decides, even if I am going to harvest the crop on 5th of September, the last date which is available for me is 31st of August. What if the fluctuations happen?
No, no. Can we take the same example of oil?
Yeah, we can take the same. In
Hmm.
fact, oil is also, I mean, in fact, it can be even bigger in the case of oil because there will be a lot of quantity involved. So let's say the company decides to leave the position unhedged for the next 5 days. You can think that because of extreme market fluctuations, what will happen suddenly if one of the Middle Eastern countries declares a war
Mhm.
on the other country, or
Hmm.
what if some accident happens in Saudi Aramco,
Hmm.
because of which suddenly the prices go up, and
Hmm.
the just because the jet oil company made this mistake, the airline company made this mistake of keeping
Hmm.
it unhedged, because of this massive
Okay.
uncertain event happened. Okay, they
Hmm.
have to
Got it.
pay the
Got it.
price.
Got it.
Got it?
I
Okay.
had that in mind, but just I was
Got it.
not
Yeah,
sure.
yeah. You should
Okay.
definitely ask. You should definitely ask.
Thank you.
Can we create? Yeah. Can Avyank is asking? Yes, that we'll discuss, Avyank, after some time, stack and roll, okay? And this also costs have to be understood. If the transaction costs are lower, then we can go for this arrangement also. Okay, Vedant is asking, is there a usual time period length to calculate the correlation? I mean, is there a way to know how much time is sufficient to assess? Yes, I think I think yes, there is should be some time period, but yeah, the rule of thumb is that in these cases, now there are two aspects to time, Vedant. Two aspects. First is what is your frequency of data sampling? What I mean to say, whether you want to use daily prices or monthly prices or yearly prices to calculate correlation. That is one aspect of time, Vedant, correct? The frequency. Another aspect of time is the total duration. So even if you are using daily prices, how much data you want? Okay, do you want 365 days of data? That is 1 year of data. Do you want 2 years of data? So the idea is that it's always better to have more data in your basket. And also to calculate correlation, then instead of using the usual methods of calculating the correlation, it would make more sense to give higher weights to recent data. Because if you see, in case of correlation, mostly what we have seen, we have calculated the correlation based on a uniform weight, right, to all the observations. Correct, Vedant? When we were discussing this for the first time, correlation in sample moments, we gave uniform weights. But don't you think it will not be a very good idea to give same weight to the past observations also? Because it is possible that the market structure itself has become very, very different. Just like I was giving the example of gold. You know, gold had a very different kind of correlation structure and volatility structure in 2005 as compared to 2025. So even if we collect, say, daily prices, if you want to have the correlation which we want to find between daily prices, if we take the data for 20 years, the data of January 2000 2005, is it more relevant is it equally relevant as compared to January 2025? Exactly. So more weightage should be given to recent data points when we are calculating correlation. That should be a better idea, I think, right? And it has been discussed also in part 2 syllabus. Okay. So Gauri is asking correlation to spot price, yeah, or future. Again, it's your choice. Actually, this is also a very important point. What we are calculating right now, are we calculating correlation between the spot prices or between spot and future? Actually, we are calculating the correlation over here, Gauri, between spot and future prices. Now, you may ask a counter question to me. Yes, sir, if we are calculating between spot and future prices, the future contracts are immediately expiring. The future contracts were not there. The same future contracts were not there in 2005. How can you say this? So the best way to understand this is that we are calculating the correlation between spot and the nearest future contract. Okay, that is the idea. Is it clear, Gauri? To make things simple, because we have to make a choice, right? It cannot be completely, we cannot have the same contract running for 20 years. That's not possible. So this is the idea. Okay, fine. So is this idea clear? Cross hedging, which contract you have to choose, because this is one of the very, you can say, easy and hot topics for the exam. This question, if it is asked, you will be able to answer it quite easily. Okay. Now let's come to hedge ratio. Now hedge ratio is the size of the position. Okay, I'll just take a 2 minute break. I'll just have some water. I'll be back. 2 minutes. Okay, I'm coming. Okay, let's continue. So the hedge ratio is the size of the position taken in futures contract to the size of the exposure. So size of futures with respect to the size of S. Now, when the underlying asset of the futures contract is the same as the asset being hedged, so there is no problem in that. Same asset, which means hedge ratio will be simply equal to 1. But cross hedging requires a hedge ratio. If you're using different assets, then it requires a hedge ratio that minimizes the variance of the hedged position, not necessarily setting it to 1. Okay. So let's see how it is derived. Okay. What is the formula? So this is the formula for optimal hedge ratio. H star is equal to rho S comma F multiplied by sigma S by sigma F, where sigma S is the standard deviation of delta S. Sometimes, to make things simple to understand, we say sigma S is the standard deviation of S directly. So sigma S is the standard deviation of spot prices. Sigma F is the standard deviation of futures prices. That is the simple convention, layman convention, but this is the pure technical definition. Sigma S is actually the standard deviation of change in spot prices. Okay. So you calculate the individual delta S values and then you can calculate the standard deviation of that data. That will give you sigma S. Similarly, you have sigma F, and of course, correlation is between delta S and delta F. Again, to make things simple, we generally, say that it is between S and F, but technically it is between delta S and delta F. Now, tell me one thing before we proceed. Does this formula ring any bell from another chapter, particularly in quants and also in foundations of risk management? Any similar formula you have seen? Similar formula. Same structure. Anyone?
Beta, sir.
Very good answer. Beta. We have seen this formula, beta, in regression, right? So beta was derived like this. Now, can you tell me if I give you two options, was this beta or this was beta? I'm just trying to, make sure that there is no confusion in your mind so that, we can choose the correct one also. Do you remember which one was the correct one?
Second one.
Okay. Are you sure?
Yes, sir.
No, it was the first one. It was actually sigma y by sigma x. Okay. Because if you remember in the numerator, when we derived beta for the first time, what was beta? In terms of covariance, covariance between x and y divided by variance of x or variance of y. What was the formula? Variance of x or variance of y?
Variance of y.
Variance of y. No, it was covariance between x and y divided by variance of x. Again, I'm using the mouse, not the pen, so I don't have it today. Sigma square x, variance of x. So if we change it to correlation formula, we actually used correlation times standard deviation of x multiplied by standard deviation of y. So standard deviation of x in the numerator used to cancel with one of the standard deviations in the denominator, and we were left with this formula. Remember now? Okay. So this was the correct formula. This is not the correct formula. Okay. So see why I'm trying to recollect you precisely using the X and Y also, because many candidates, they tend to get confused that, futures is on the Y axis and spot is on the X axis. No, spot is actually on the Y axis and futures is actually on the X axis while plotting this regression. Okay. And finding the perfect formula. Okay. So you see, hedge ratio is this ratio which reduces the variance of the position overall. Okay, it reduces the position, the variance of the position overall. Now, this is the regression. See, delta S is on the y-axis and delta F is on the x-axis. Okay, so H star is kind of, H star you can define it like this, right? The slope of this graph, correct? So what is the change in S per unit of change in F? This is your H star, the slope of this graph, okay? Now, if suppose H is 1.5, if H is, H star is 1.5, are we talking about 1.5 units for one spot or 1.5 spot for one future? This is also one of the confusion that come into your mind. So please make sure that you understand this, that we are talking about 1.5 units of futures for 1 unit of spot. Correct. Okay, this is the idea. So that's why these things I've highlighted over here and kept it in different slides, okay, properly. Now, what is the hedge effectiveness? The hedge effectiveness can be defined as the proportion of the variance that is eliminated by hedging. Now, this learning objective has been removed from the GARP syllabus, I think after 2022. Okay, but this is a very simple formula, very easy formula. So I would urge you guys to just remember what is the hedge effectiveness, because it is one of the parameters which can be asked during an interview also. You never know. So it's a very simple formula. R square is equal to rho square. Okay. Now let's just again do a quick recap from regression. Do you remember R square from a single regression was equal to how much in terms of correlation? What was the relationship between R square and correlation between X and Y? Again, we are going to quants. Quants revision is going on. No, only in terms of correlation, not RSS, I'm asking. Only in terms of correlation. It was simply equal to correlation square. That's it. Okay, but I had explained one more thing in multiple regression. I had explained that R square for a multiple regression is also the square of correlation, but it is not the square of correlation between X and Y. Which correlation we were talking about over there? This revision is not related to this chapter, but this revision is just to make you recall the concept, because whenever we get a chance, we should do these things. Okay, this is from the quants chapter. Now, can you tell me for multiple regression what was R square? Quickly, just try and recollect. It was also the square of some correlation, but not X and Y. And this can be asked in the exam. That's why I'm highlighting it once again. That's why I'm doing it during the revision. See, most of you don't remember because this idea is ignored. I mean, we discussed this in detail in the class. Okay. It was the correlation between Y and Y cap. Okay. The square of the correlation between that. Yes. Actual and the expected values. Correct. So now do you remember? R square for single and multiple regression. Okay. So this is just a quick recap from wants not to be used in this chapter anyways. Okay. So now this is a very important learning objective. Optimal number of contracts. So this is the formula to find out the optimal number of contracts to hedge a portfolio, where what is QA? QA is the size of the position being hedged. QF is the size of one futures contracts in units, both of them in units. So let's take an example. Let's say you have $800,000 gallons of jet oil as your spot asset. Okay. And the volatility of jet oil is given to be 8%. Again, for the sake of simplicity, we are not using sigma delta JO. We are just using sigma JO. And instead of jet oil, you have heating oil as your hedging instrument. So you go to the futures market and you find that jet oil is not available, but heating oil is available, which is having a decent enough correlation with jet oil. Okay. So their standard deviations are given and the correlation is also given. 89% correlation is there between jet oil and heating oil futures. Okay, so that oil A and oil B, which we were discussing earlier. So maybe this is oil A, the jet, the heating oil. Okay, now you are given that the contract size is 40,000 gallons, let's say. Okay, and again, these numbers have been framed just to make sure that you understand the calculations properly. Okay, practically, generally, if you see, gallon sizes are generally in 10,000, or even 1,000 gallons. Okay, but we have just changed the numbers so that you can understand the calculations properly. Okay, what will be hedge ratio? What will be hedge ratio? Hedge ratio will be simply this. Same formula we have to use. Okay, this formula, H star, rho times sigma S by sigma F. Okay, so can you tell me what will be the hedge ratio over here? Quickly send your answers. Rho times sigma S by sigma F. Just tell me the hedge ratio quickly. How much you are getting? Correct, 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 correct. It is approximately 1.42. So what is the number of contracts that we have to go long on? Let's use this formula. N star is equal to H star. H star you have already found out now, 1.42. Okay. So QA by QF. Just multiply 1.42 by QA by QF. QA is the size of the position being hedged in units. How many gallons you have to hedge? And QF will be the size of one futures contract. So you have to hedge 800,000 gallons. And H star is 1.42. So how much you are getting? Okay, 28 long. Okay, correct. So it is 28 long. So since you are getting 28.48, you might also be tempted to say 29. Even 29 is okay. Both answers will be correct. Okay, but just let's make it a rule of thumb to avoid any confusion in the exam. If suppose we are getting less than zero point 0.5, then we will round it down. If we are getting greater than zero point 0.5 in the decimal places, we'll round it up. So since we have got 28.48, we'll round it down to 28, Nitin. Okay, that should be a rule of, because in the exam, let's say if both options are there, which one will you choose? Let's round it
Sir,
down. Yes, Prashali.
sir, I'm not able to relate to all of this.
Relate to?
Relate to all of these formulas and everything. Also, my
See,
quant parts is left a little bit.
don't worry, Prashali, at all, since this is your first class, right?
Yes.
Yeah, yeah. So don't worry at all. As it was mentioned, see, just go through the recordings properly. It will take 2 or 3 weeks time, and of course, we are always there to provide whatever assistance you need from our side, as mentioned in the discussion earlier. So it will happen. See, for those of you who are having their first class, they will actually find it challenging, particularly if you have not watched the videos of the previous classes till now. It will be challenging. It will take 2 or 3 weeks time. Things should get settled, especially if you're not a working professional. Okay, if you have taken a break, as we had discussed, then I think things will definitely, 3 weeks is the maximum time. I'm telling you, Vaishali, 3 or 4 weeks, it will settle down. Don't worry. Because see,
Okay.
to understand the next few chapters also, quant's background is not heavily required. So quants can go on parallelly. But within 3 weeks, you will know that much that you will be able to understand all the future chapters properly. Okay. And of course, quants part can go parallelly. It will take some more time. Okay. So don't worry at all. And this message is not only for Brishali, but for all the candidates. I think Zainab also is having her first class today. So the candidates who are having their first class or second class or even third class, no need to worry. Things will take time, okay, and they will get clear gradually. Don't worry. Lucky is asking, how does this 800,000 come? This is given to you, okay. This is the amount of jet oil, Lucky, that the airline company requires. 800,000 gallons, depending upon their the number of flights that they have to operate and the number of aircrafts that they have. Okay, and of course other liabilities, other operation, testing, investing, anything, a lot of things are there. So they have estimated this is their requirement, so this will be given to you in the exam. Okay, so we are going 28 long. Now see, since even the long position, short position, all these things have been discussed in so much detail in the previous class. So obviously, if you are having your first class and if you don't have a very strong background, so a lot of things will not be clear to you. And even on the quant side, okay, the hedge ratio part. Maybe because Vrashali, you have a background in finance, right? So you might be able to understand long short easily, right? But this
Yes,
part will not be
absolutely.
clear to you, correct? H star. How exactly we
Actually,
can
the actually the formula parts are confusing.
correct,
You know,
correct,
the
absolutely.
theoretical
Yes,
part,
yes,
what
yes, yes.
long and short and everything you were
That is
explaining
clear. Yeah,
previously,
yeah,
that
yeah.
was okay.
Yeah.
The formula part is
Formula
panicking.
part is not clear. Correct. So that's why I said you might be very clear with this part, long and short, what exactly the mechanism is, but you're not clear with this part, the formula part. So those things will get clear once you go through the videos properly and do the revision. And there may be some candidates who might not be clear with the long and short part. They might be clear with the H star part. Those who have done quants lectures, like Parth, you missed the last lecture, right? You well, have not watched the video also. So that's why you're
Yes.
asking these questions of future. So again, if the coverage is complete, it will be clearly, it will be more clear to all of you. And the good part is that we are also taking a break next week. Instead of having the break on 10th of August as our weekly, you can say the week after every block that the break after every block that we take, we are taking this break sooner. So it will be better for those candidates who have joined late. At least they'll get more time to try and recollect all the things properly, try and make a structure that, okay, these are the topics which are required for the future topics. So let me first cover these topics quickly, and then they can start quants part also parallelly. So Vedant is asking, hedge ratio is the factor for a unit. Then we multiply by the ratio of the main and cross asset. Absolutely correct. Okay, absolutely correct. Okay, now again, just to revise, just to give a quick revision over here, we got 1.42, right? So I'm giving you two options. Is this 1.42 units of futures per unit of jet oil, or 1.42 jet oil per unit of futures? That is 1 unit of futures per 1.42 jet oil. Which one is correct? Option A or option B? Okay. Okay, this will be your homework. Okay. Because we have already discussed this just in the previous slide. So let me know, what do you think this immediately after the class? Think about it properly and make some revision of the beta part in regression also, so that this becomes more clear to you. Okay, although you don't need that revision to understand this idea, even if you don't understand it technically, you will be able to relate it properly if you see the H star formula also. Even then, that gives you a hint of what actually is happening in H star. Okay, but in isolation, if you want to analyze H star, then you have to go to the beta part also and see what exactly is happening in the regression. Okay, so just do it after the class. Make sure that you do it after the class. Okay, now tailing the hedge, as I told you that, we'll just be discussing a formula. We'll not discuss the mechanism in detail. So tailing
Sir, there
the hedge
is
means
one
what?
more.
Yes,
Sorry,
Bob.
sorry to interrupt.
No
There is one
problem.
more formula.
Mhm.
Like number of contract is equals to beta of portfolio
That is
into
coming later
port.
on. That is coming
Okay,
later
okay,
on. Okay.
okay.
Yeah. So tailing the hedge means what? It means that as the prices continue to change, the spot and futures prices, as they continue to change, obviously the value of n star should also change, because when we talk about quantity, that quantity is at the current price when we are entering into the hedge. But what if someone wants to hedge later on? Okay, or what if the same person who hedged initially, if they want to make sure that their hedge ratio and all the number of contracts and everything is still optimized? Okay, so in that case, you actually multiply QA by QF by S over F as well. So it means that your new N star becomes your old N star. This is your old N star. You simply multiply it by this quantity S over F. Okay, but again, there is a trade-off. Will you do it regularly? Will you do it daily? Because you will have changes in spot and futures every single day. So will you do it daily? No, it does not make sense to do it daily if it involves a lot of transaction costs. Okay, so tailing the hedge also requires a balance between costs and benefits. So if the benefits of hedging are not that great, if you're getting very minor benefits only, that okay, your hedge is completely locked and you have created a perfect hedge by using this H star and the QA part. But still, because of these minor fluctuations, your hedge is now not perfect, but still it's not very bad. Okay, so why to incur extra transaction costs every day? Because every time you make a transaction, you'll have to give money to your broker, the commissions and all will be given in terms of bid ask spread, all these things will be there. So you should maintain a proper balance between them. Now let's come to the optimal number of contracts for stock index future.
Sir,
Yes, Parth.
there is a line to correct the possibility of overhedging. A hedger can implement a tailing the hedge strategy.
Mhm.
So can you give an example for tailing?
Yes, I mean, I can give you an example over here. Let's say you hedge today and the price of the asset. Let's take an example of this jet oil only. Okay.
Mhm.
Because of, again, any kind of situation, the price changed drastically and the ratio of the spot and futures, maybe it changed from, say, 1.2 to 1.5. Suddenly this ratio changed. Okay, so it means that the spot price has increased by a much higher amount as compared to the increase in futures prices. So it means your hedge is now disturbed, completely disturbed. Okay, or it is also possible that you have actually you have the S goes down and you have in your position much higher number of future contracts than were actually required. So if earlier we required 28 long contracts, and because of some market changes, because of the changes in spot and futures prices, you now only require 25 contracts. So it means that you have
Mm.
overhedged, correct? You have
Yeah,
three
I was
contracts
coming
extra.
to that point actually.
Mhm.
What is the meaning of optimal number of contracts? What does it actually mean?
Optimal number of contracts means exactly that, those number of contracts which will make sure that if your spot prices are fluctuating, your futures contract value is also changing by that amount,
Mm.
exactly by that amount, which is offsetting your position, which is offsetting your losses from the spot position, or which is offsetting your gains from the spot position.
Yeah, that is a technical like definition, but what does it actually mean? Like the idea of contract which we have in mind is something which we agree
Understood.
upon.
Understood. See, let's say in this case, we have calculated everything and we go 28 contracts long in the futures contract. Now, what happens is that the price of the spot price changes drastically. And now, without any calculations, if you just want to understand what exactly happened to your portfolio, see, one thing is very, very
Sir,
clear.
I understood that
Okay.
due to the change in S and F,
Yeah.
now you will require a lesser number of contracts.
Mhm.
But what is that contract
Yeah, and
that I want to
what is that
understand?
contract? Again,
Hmm.
please watch the video of that future, because what is that contract? If you need to understand, you
Uh,
have to watch the futures video properly, because
like
all the
what I was thinking
questions.
that we can have same thing in one contract as well. Like
No, no, all the questions that are coming from your side, Parth, are completely related to what we have done in the last class. That's why we have
okay,
actually defined a contract. Okay, Parth. We have
okay,
defined a contract. We have seen how many number of units can be there in each contract. We have given
okay,
examples also. That's why. Okay.
okay,
If
okay,
that
got it.
part is the only doubt, then you can watch the futures
Yeah, yeah,
video.
yeah.
Okay.
That much only.
But since
Okay.
you have asked the question, I'll just explain the idea also to everyone else also in brief,
Mm-hmm.
that basically what is happening without calculation, I'm saying this, that we actually take opposite positions over here also. We know that in hedge we have to take opposite position. So the same thing that we discussed earlier, if the price of spot is suddenly going down, your futures are making sure that if you are losing something in one of the asset, then there is a gain in the other opposite side wala asset, so that your net profit or net loss becomes zero. That is the idea behind hedging. Okay. There is another point which has been raised by Vedant. Vedant is asking, we can tail the hedge. when the S by F ratio has changed significantly from what was observed exactly. So from what was observed from the last time, that is where we are tailing the hedge. That is exactly what we are doing. Suddenly, if the S by F ratio changes, we have to make sure that we tail the hedge. Absolutely correct with that. Then uh, Ujjwal, I think there was another question which has been deleted. Okay, so I think that doubt might be cleared. So Avyank is asking 28 long means 28 lots. Correct. In terms of the language which is provided or which is generally used in the exchange or between the parties, they generally actually mean 28 lots only. So by 28 contracts, 28 lots, 28 long. That's it. Okay, correct. Now let's continue to tailing the hedge. So this is the formula for tailing the hedge, and we were discussing this. Yeah, we were discussing the optimal number of contract in case of stock index futures. Now, if the portfolio that you have mirrors the index and you want to use the index futures to hedge your position, so you have a portfolio of stocks. Okay, Aram, I'll answer this. Okay, so you have a portfolio of stocks and you want to hedge the portfolio of stocks now. We're not talking about any commodity. Now we are into financial assets. So now if you want to hedge this portfolio of stocks, what options do we have in the market? Obviously, we will not get the same portfolio of futures in the market because my portfolio is something which I have created. Why will any exchange have a standardized portfolio like that, right? So I have say multiple stocks in my portfolio, 32 stocks in my portfolio. Now, if suppose my portfolio mirrors the index or it follows the index very, very closely. So basically, I have kind of built like a passive benchmark kind of portfolio where I have just made sure that, all the assets in the portfolio are actually in the same ratio. The composition of the assets in the portfolio is in the same proportion as the market capitalization of say Sensex in terms of all the companies which are there in the Sensex, okay, or Nifty 50. So that is what I have built. So obviously I can use Nifty 50 futures to hedge my portfolio because that is the portfolio that I have built, right? So when I say mirrors the index, what exactly do I mean? I mean that the hedge ratio is simply equal to 1. H star is simply equal to 1, where of course VA is the current value of the portfolio and VF is the current value of one futures contract, which is calculated like this. We'll see an example of this part, IL multiplied by M. Now coming to the questions. Ram has asked, what is the main purpose of cross hedging? The main purpose of cross hedging is exactly the same as the main purpose of hedging, Ram. Just the same thing that we have been discussing since the beginning of this chapter. Like the jet oil company, the airline company, it is concerned that the prices of jet oil will rise on 5th of September or 5th of November, whenever they have to buy it. So they hedge using heating oil because jet oil futures is not available now in the market. Okay, in the futures market, this company goes to the futures market, but the company finds that jet oil futures is not available. So they have to go for cross hedging to prevent their losses. Understood? So that is the purpose. Okay, that they have to prevent their losses. Losses what? Losses of losses because of prices getting high and the losses because they might have to buy at a higher price. That is why they want to prevent it. They want to lock in their buying price as much as possible. Since they don't have jet oil futures run, obviously it will not be possible to lock it perfectly. So they look for something else which will make sure that they lock it as closely as possible. Now Vedant is asking mirror means a good, yes, a very good correlation between spot price. You can say almost perfect correlation. Okay. That is the meaning of mirror. So let's take an example of mirrors. So see this question, please, and send your answers. Okay, I'll just write this is your VA, this is your IL 500 times. Okay, and this is sorry, IL is index level, sorry, and this is 300 times. This is the multiplier. Okay, index is at $500. I think it would be better. We can write this dollar over here. Although this is actually a, okay, this is also a good practice. Sometimes we use dollar instead of dollar for the multiplier also because finally if you are multiplying these two, anyways, you're getting dollars. but this is okay for you guys to understand it properly. So I've given you M, VA, and IL. You have to use this formula VA by VF, where VF is this IL times M. So please send your answers quickly. Three? Okay, everyone is getting three.
3.
Correct. So it is VA divided by VF, which is 3. Okay. But see, will it be the case where the portfolio will mirror the index? It will be very, very rare. Okay. Yeah. In practical cases, investors don't typically have portfolios that mirror the index. We mostly, I mean, if you just have to create passive portfolios, then simply why not invest directly in a benchmark? Okay. There are a lot of options. If you are making making an active effort to create portfolios, generally it will not mirror the index. You will definitely try to get some extra return apart from the index, or even for that matter, even if you don't try for that, it is actually very difficult for you to exactly make sure that the proportion of all the stocks in your portfolio is same as the index, because even the index composition is changing every day, right? So in this case, the best proxy for H star is actually beta from the capital asset pricing model. And it makes a lot of sense because the mechanism, the derivation, even the idea, the concept is exactly the same. There's no difference in the concept. Okay. So beta becomes your hedge ratio, and this is the formula. So instead of H star, you have beta now. Okay. So beta is a best proxy for H star. So this is the question. This is your VA, this is your IL, this is your M, and this is your beta. So please send your answers quickly.
Sir, in exam, do we have such type of questions like the level of difficulty?
Sir, I guess your voice is not audible if you're speaking something.
Oh, I'm so sorry. I'm so sorry. So sorry. When was it
Yes,
muted? When was it muted? Just now, na?
I think someone earlier was asking any
I asked
question
a question.
also.
Okay, Parth, you asked a
Yeah.
question. What was the question?
Mm, I forgot it. Just
Over here, were you able to hear me over here? Best proxy for H star
yeah,
and
yeah, yeah, yeah.
Acha, acha. So only
After
now.
after you give, I have given the example.
Okay, so when I said send your answers, I think then I muted and
Mm-hmm.
yeah,
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 yeah.
got it. Okay, so
About what I was asking.
Yeah.
Is the difficulty level in the exam
Oh
same as
my
this
God.
question?
I have explained that in so much detail the entire time the mic was muted. Okay, I'll do it once again. So I said that yes, see, GARP has a very diverse set of questions, and there will be such questions also which will be easy because there are questions which take more than 3-4 minutes to solve. If you see the average number of the amount of time that is allotted, 4 hours means 240 minutes. You have 100 questions, right? So you have 2.4 to 3 minutes to solve each and every question. So it is quite challenging. There will be some questions which will take even 3-4 minutes to solve, some of the very difficult questions. So obviously you need to have some questions which can compensate for the difficulty level of those questions so that the time can be managed properly. So I think 10 questions are super easy. And I just give you one more. Uh, I think it may not necessarily be true, but I'm just giving you this trend which we have observed. And this trend was more evident in 2017, 2018 because GARP had actually introduced new sample paper questions that time. Because if you see the sample paper questions of GARP year on year, they change their questions very in a very limited way. So most of the questions are retained actually from the previous sample paper questions. But these were the 2, 3, 4 years I think where a lot of new sample paper questions were introduced. And I think during that time, we were seeing straightforward, from the sample papers, straightforward without even changing the numbers. 8 questions were there, 9 questions was there. So it was actually quite surprising. And in fact, it was a pleasant surprise for the candidates as well. Okay, so that they could actually identify such questions because see, even though it won't make any difference to the percentile, because if you are getting it right, many of them are correct getting it right. But of course, it makes the job of serious candidates who have prepared well, who did the GARP sample paper questions properly, even if their concepts are, let's say, not up to the par 100% clarity in the concept, but they worked hard. They covered every single resource, nicely. They will be in a very good position, and also solving questions in the exam, getting them right actually gives you that momentum which you can build throughout the exam. Because for many candidates, it's kind of a momentum phenomena also. I've seen it's not only about a FRM exam, right? If you get 8 or 9 questions correct, in the first hour only, then of course it gives you a very good momentum. In the first hour means 8 or 9 which were familiar. Of course, you'll get more questions also correct in the first hour. You should target 25-30 questions at least in the first hour, 25 to 30 questions. But out of those questions, if 8 questions are there where you have a lot of familiarity and you're able to answer directly without even calculating because you saw the exact same question in the sample papers. But now this trend has reduced a little. Although it's still there, there will be a few questions which will be exactly same. It is possible. But now in most of such cases, they actually change the numbers. Okay. So I was coming to the difficulty level. 10 questions will be super easy. You can say 30 questions will be medium difficulty, 30 to 40. 40 to 50 questions will be tricky. Uh, you can say at a higher difficulty level, and 10 questions will be super difficult. So this is a overall tentative composition that you can expect from the exam. Of course, the sets will be different, so it can be different for each one of you. But this is the average that we can expect out of all the test sets. If we calculate the average, this is something which we can expect. Okay, correct. 290 is the correct answer for this particular case. I was saying that if we want to manage beta, if in order to change the original beta of the portfolio to a target beta, a long or short position should be taken in n star number of contracts depending on the sign of n star. So the number of contracts used for hedging is given by this beta star minus beta multiplied by VA by VF. If beta star is less than beta, sign will automatically tell you whether you have to take a long position or short position. So you can take this example. You have the current value of the S&P is 3150. Again, just go through this and send your answers quickly, at least for one part. At least you can send the answer for part A, and part B we'll just skip. Okay.
Sir, why do we need to change the beta?
Again, your choice. That is completely your choice. There can be multiple motivations. If you ask me the motivations, there can be motivation. See, you are a investor who wants to take more risk as compared to the market. Okay, let's say
Hmm.
your current beta is 0.9. Now
Hmm.
you have
Beta
a
is
lot
a
of money.
systematic risk, right?
Exactly, systematic
Hmm.
risk. Okay, so you have a lot of money now and you feel that okay, you can risk more money and you can make your portfolio more volatile in the market also and more risky also. Because once you do that, obviously you will be rewarded more as compared to the market. Okay, so that is one of the motivations. Or else, if you want to become more conservative, maybe you have some kind of savings plan coming up and you don't want to take too much of risk. So that's something also which can happen.
Okay, so in example, the current beta is 0.95 and you have to change it either to zero point 0.5 or 1.2.
Correct, correct,
So,
correct.
so who gives this number 0.5 or 1.2?
Again, it is the investor's preferences. It is the investor's preferences which can be either governed by the portfolio manager. Portfolio manager can give suggestions. If suppose I am managing your
In the
portfolio,
sense, how do they come to this value?
uh, uh,
0.5 or
this
1.2?
is this value again. If I tell you that okay, see Parth, I am your portfolio manager. I tell you that Parth, the market is going to become very risky in the next 6 months. Okay, and I believe that you should reduce the beta of your portfolio. So you will ask me naturally. You will ask me that of course I can, but by how much? What should be the number? Right. So I'll tell you. See, based on your investment goals over the next 6 months and the amount of money that you might require and the amount of money that you may want to also withdraw so that you want to keep a stable portfolio, so you can reduce your portfolio risk to about 50% of the market risk. That is what I'll give you feedback and then you can take a
And
call.
that is purely intuitive.
Intuitive, mostly yes, and you can do the calculations also that if suppose this is the expectation from the market based on volatility and based on the projected returns, this is the assessment of the market and you decide that no, this if the market can yield say negative 15% over the next 6 months,
Hmm.
I can only suffer negative 7.5%.
Hmm.
Then you will go for 50% of beta approximate.
Yeah. Okay. Got it.
Okay. So combination of intuition, judgment, and a little bit of approximation because even these
Hmm.
calculations will not be exact, right? It is not even
Okay.
possible to do it. Okay.
Okay. Thank you.
Yeah. So in the first case, correct. Sell 128 or 129. Correct. So negative 128.57. So yeah, you can say 129. That will be better on the higher side. Okay. So yeah, this is the case. Whereas for 1.2, it will be 71.43 or 71 long. Now let's come to the last part, stack and roll. Again, please do go through the main video for this particular part in detail. But even in the class, we'll understand everything. Don't worry about that. Okay, but we'll keep it a bit brief. So let's say if and this question is also related to one of the questions which was asked by one of you earlier, which I replied cost benefit analysis also, and it depends on the objective as well. So
So,
let's say there is a hedge. Yes, but Vrishali, you are asking
wow.
something?
Yeah. Sir, what do you mean by main video? The recorded videos you sent, like for the
Yes,
pre-class
yes, yes,
videos.
yes, yes, yes. The
Okay, sure.
pre-class preparation videos, pre-class preparation videos,
Okay,
which are the
okay,
recorded videos. Correct.
okay. Thank you.
Yes. So let's say we have a situation where my hedge expiration or hedge duration is much greater than the dates of all futures contracts. So my hedge is going to be long term. Let's say the let's take an example of Go Air. Okay. Anyone who lost money in Go Air flights over here last year, last year, I think 2023, right? Yeah. So 2023, I also, in fact, I'm still waiting for my refund amount of, I think it was approximately 15, 16,000. Yes, we will take a break, Nathan. It's last slide actually. This is the second last slide. Okay. So we'll take a break. So it's hardly 5 more minutes. Okay. We'll take a break now. So Go Air got bankrupt. The operations were seized and filed for bankruptcy and all. So the operations were seized. Okay. So maybe there is another company, let's say, who's not bankrupt, who's just halted its operations for some time because of technical reasons. It has been informed, and the company is planning to resume the operations after 1 year. And all the preparations are going on, or in fact it's not necessary that the company has halted. It can also be the case of a startup where the startup will require some resource, but maybe not now. That plan has to be done in phase 2 of the business, which will come after say 1 year. Okay, so anything can be there. The overall idea is that the hedge duration or the horizon is actually quite long. So after 1 year, if the company requires jet oil, but the company, when it goes to the futures market, the company finds that there is no contract at all which is available for 1 full year. The best that the company can find is, let's say, a 2 month or a 3 month or a 5 month contract. Let's the best 5 month contract. What to do in that case? Okay, so that is one scenario where stack and roll can be used, and I'll explain what is stack and roll. Don't worry. Another scenario can be that yes, it is possible that contracts do exist. It is possible that contracts do exist, but the future contract for the far dated futures contract are not very liquid actually. Okay, so let's take an example where the hedge horizon is longer, let's say 25th of December 2025, and either no futures contract are available for that time, only available till July, let's say, or else they are available but they are very very illiquid. Now what I mean when I say illiquid, let me just share my screen and let us open the MCX website directly. Let's see if we can find the future or any other website where we can have futures prices completely. So we were discussing, let me just open the same browser window which we had earlier. So this is what we were discussing, investing.com, right? Is it visible on the screen? Is it visible on the screen? Is the browser visible quickly?
Yes, sir, it's visible.
Okay, okay. So in fact, in investing.com also we can have it, but let me just show you for MCX. So let's go to MCX. Last week it was not opening properly, right? It was under maintenance, I believe. Let's hope that we are able to get the data. Now it's completely opening properly. Okay. Let's see. I'll just opt for a commodity for which a lot of contracts are available. So let me just go for commodity futures. Okay. I'll see all the commodities. Okay. So we have one contract in gold. Okay. And okay, so let me just select one commodity. I think we have more contracts for gold. It's showing one over here. We have more. We have 5th August. We have 3rd of October also. Yeah. So yeah, we have many contracts for gold. 5th of August, 3rd of October, 5th of December, 5th of February. So when I say illiquid, we have discussed illiquid. Remember volume and open interest last time. Both volume as well as open interest are a good indicator of liquidity. Correct. So can you tell me which contract is having the least liquidity based on volume and open interest? Just see the numbers and tell me. In this case, what do you think? Which contract is having the least amount of liquidity? Exactly. Last one. Only 5 contracts were traded. Okay. And only 14 contracts are open. Okay. Now, one problem, see what is, you will ask, what is the problem with illiquidity? As the days, as we move ahead and as we approach 2026 January, this contract will become very liquid. So what is the problem? The problem with illiquid contracts is that since there are many few market participants which are available, the bid ask spread of such contracts is very, very high. Okay. So you can just search over here, bid ask spread and liquidity. Okay. So you can see bid ask spread is a de facto measure of liquidity over here. Bid ask spread is the range between buying and selling price. In trading, a bid ask spread is the difference. Of course, we have seen all these things earlier. So it is the de facto measure of liquidity. So where is liquidity written in this year? So traders view the bid-ask spread as an indicator of market liquidity. High friction between the supply and demand for a security will create a wider spread reflecting a less liquid market for it. Okay. So what will happen if the bid-ask spread is high for the investor? Can you tell me? what will be the case? The investor, see, bid ask spread is what? Bid ask spread is nothing but the commission of the dealer. That is what it is, right? And if the dealer is seeing that there are very few people, very few parties or counterparties who are willing to trade in these contracts, obviously the dealer will want to make more profit per unit because the number of units are actually very less. So that is why, as an investor, since the bid ask spread is very, very high, you will pay a very high commission on that. Okay, that is a problem. Okay, and also it's of course very, very illiquid, and because of that illiquidity, the bid ask spread is very, very high. So that is the idea. So either the contract might not be available, or even if it is available, it is highly, highly illiquid. So what do we do? Correct, Vedant. Your idea was correct. Actually, no, don't say smaller, say nearer. Okay. Small number of nearer term contracts, nearer term contracts. Okay. Yeah. So what do? We actually have two options. We can either go for and I'm assuming that, uh, just give me 1 minute. Yeah, I'll just use the mouse only. Sorry, I forgot. Yeah, I'm assuming that today is, say, 10th of Feb. Okay. So if we change the date, then this example actually will make more sense because there are two contracts which are available, right? So on 10th of Feb, only two contracts were available because this is a very, very you can say minimum amount of trading is done in this commodity. So you don't even have monthly contracts. You have two contracts only. Okay. So you have two options. Either you go for the July contract and then the December contract in July. Okay, so till July you have a contract. Till July you have a contract. Sorry, I think one information that I gave you, that it is only having two contracts, July and December. No, no, that is not the correct information. It is having all the contracts only till July. Okay, so you have two options. You go for the July contract right now on 10th of February, the last contract that is available. Okay, which will be the most liquid, most illiquid on that day. On 10th of February, the last contract, which is July contract, is the most illiquid contract. And then as soon as July is reached, there is a chance that December contract will be opened. So because in February, if you're already having the July contract, then it is possible that in July, you might be having the December or at least the November contract for sure. So this is one option for you. You go for the July contract now, and then you go for the December contract in July. Another option is that you go for the February contract, then close it. Okay, just before the end of February, you close it, you enter into the March contract. Just before the end of the March, you close the March one, you enter into the April contract, and you continue this till December. Okay, so which option will you choose? Yes, Nitin, it will be clear. Don't worry, it will be clear. Which option will you choose? Okay, I'm repeating once again. Today is 10th of February 2025. So if you look at the futures contract, let's just again go to the same website. This one, right? So we were seeing market watch. So for gold, we are seeing that from today, we are having contracts all the way up to February. Let's say for some other commodity, we are having, say, lesser contract. Let me just check. Let's say lead. See, for lead, we are only having two contracts. Okay, Nitin, do you have the December contract for lead? Is there any option for the December contract? So if you are a company which needs lead, do you have, and you know that you will need it in December to make lead pencils, do you have an option to lock in your price by directly entering into a December contract, Nitin? Just check this and let me know if you're convinced or not. Just check. You have only two options, 29th and 30. Are you able to hear me? I think, is the voice going through? You're not answering?
Yes.
Yeah. So is it clear, right? That you don't have any contract? Okay. So since you don't have any contract, you can go for something called as stack and roll. You can go for this. You go for the current contract. Okay. So we are assuming today is 10th of February. So you go for the Feb, then you close Feb before just before March. Then you close March just before April and you continue this till December. So I asked which option will you prefer? Will you prefer this option? Only two contracts, or will you prefer the second option? So intuition will tell you that you should go for the first contract, because you might be feeling that, even if I save commission by going into the, the by opting for the second route, still there are so many transactions. It is possible that, the net commission which I pay by entering into these so many contracts may be greater than the commission which I will pay by entering in the two contracts. Okay. Although the commission for the two distant contracts are very, very high. Remember that. So maybe you might think that, okay, what is the commission that I'll uh, incur over here? Even if two large commissions are there, it will be, let's say, $1 per unit. But in this case, it might be, say, $0.25 per unit, but it is possible that since I'm going through 10 different contracts, my total commission may even add up to $2.5. Okay. But I'm telling you, in most cases, absolutely correct, Arijit. In most cases, the individual commissions of the farthest contracts are actually very, very high. So even if you add them, okay, they are, even if there are two commissions only in total, even if you add them, it will be higher than the sum of these 10 commissions. That is the problem, because the contracts were so illiquid. You see this. Can you compare? Can you even compare the size? You see 9,000 lots and only 5 lots. So the bid ask spread for the large, the we can say last dated contracts are actually very, very high. Those who have their accounts, commodity accounts, they can check this clearly. Commodity futures, I think, was also available on Zerodha for trading as well, or even stock index futures. You can check the future dated contracts will have a very high bid ask spread. Okay. So that is why the good option is to go for this. You take the nearest contract, shorter duration, minimum transaction cost. Then just before the contract is about to end, you settle it, you offset it, and you enter into a new March contract. Just before the March contract is about to end, you again settle it, you enter into another contract. So you do this process till December. This is known as stack and roll. Is it clear now to everyone? Nitin, is it clear to you? You were asking not clear. You're saying not clear. Clear now? Okay, great. Okay, Vedant said clear. Nitin, is it clear to you?
So I have to go revise again, and maybe
Okay,
I'm not
okay,
really
okay,
100% as of now.
okay, okay. Avyank is asking, why do even 5 contracts exist if that is a bad option? What could be the possible reason for someone getting? Excellent question. Why do these contracts even exist if the liquidity of such contracts is so low? See, again, it depends on the instrument also, Avyank. Over here, I'll just go back to this. When I change it to lead, then they are not even existing, correct? Avyank, agreed? So it all depends on supply and demand. And you see, the volume is only 288 lots. You compare it with gold, it is 9,000 lots. So even for the nearest contracts, lead is only having a limited trading volume of 200 lots something. This case, gold is having 9,000 lots. Okay. So since this commodity itself, this underlying asset itself is so heavily liquid and so much is demand, that is why it is assumed that there might be a possibility that, investors might use a longer term horizon also. And see, this is all based on supply and demand again. If suppose they open this contract, okay, Avyang, and there is no one, zero volume is there, will they even continue this contract, Avyang? Will they even continue this contract? Do you think exchange will continue this contract if the volume is zero? Obviously not. So they are opening this contract. Even this contract, you see, the December contract of gold is having a comparable liquidity in terms of the volume, not in terms of bid ask spread, in terms of volume only. Of course, this is also illiquid, but in terms of volume, it is still comparable as the near contract of lead. Can you see that? Right? So it all depends on the commodity. So for example, these commodities, gold, crude oil, even silver, okay, these are massively traded, massively invested commodities, massively used commodities in the world. Silver is an industrial metal. It is having a lot of applications apart from precious metals, apart from it being a safe haven investment like gold. Silver, unlike gold, has a lot of industrial applications also. That is why many investors bet on silver instead of gold over the long run. You analyze the gold silver ratio also, you'll feel that there have been a lot of erratic fluctuations, but overall the trend, in many you can say many phases have been there throughout the last 40-50 years, where the ratio has actually, the gap between them has reduced, so the ratio also of gold is to silver price has decreased. Many a times it has happened, but again it widens because people again go towards gold and again it widens. But silver has dual uses. It is a safe haven precious metal, considered to be, of course, and it also has a lot of industrial applications. So you'll find for silver also there might be many contracts like gold. Okay. So we can see for silver, let's see. See for silver also. See, in fact, for silver, you are having till May 2026. Okay. In fact, it's actually the same because the first contract is for September. That's why. So there are four contracts only for gold as well as silver. Okay. Even for crude oil, you'll have more than lead. You can check it. Three contracts, at least more than lead, right? So it depends on the commodity completely. And of course, the geopolitics also involved around it. Crude oil has a completely different dynamic as compared to other commodities. Okay, fine. So there will be rollover or basis risk with the stack and roll strategy, because even though commissions will be less, but rollover or basis risk will be higher, because every time there will be, you are exposed to this basis risk every single time. Okay, for a single contract the basis risk is lesser. For this contract, every time you're getting exposed to a new basis risk. Okay, this part has to be covered from the PDF. Cash flow considerations, this is also an important part. Okay, fine. Okay, so that's it for this particular session. We had a very long session for only one chapter. In fact, generally this chapter is over by 2 hours maximum for all the batches, but it took more than that, and most of the questions, in fact almost all the questions I'll say which were asked by all of you, were extremely good, very relevant questions. So yeah, please go ahead, Parth.
Sir, can you open the slide of optimal hedge ratio?
Yes.
You said that on the x-axis and y-axis we mark something. Can you repeat it?
Yeah. So on the y-axis, you have delta S, not F, I said. Okay.
Mm-hmm.
So some candidates, they get confused because see, the intuition.
Delta S or sigma S, right? The standard deviation.
No, this is delta. No, when you want to find out H star, this is regression actually, which we are carrying out to
Okay.
find out H star. Okay. So when you find out H star, you carry out a regression between delta S and delta F. Now, why I said that there can be a source of confusion, because see, what will be the intuition when you talk about hedging? You are actually using futures contract to hedge spot positions. You're not doing the opposite. So
Hmm.
that is why your first intuition can be, to find out the hedge ratio. Maybe futures will be on the y-axis because futures is dependent, right? We are using futures to hedge spot. So spot should be some kind of base. No, that is something else. That logic is something else. This is a regression which is being carried out to find out H star, which is
Okay.
done between delta S and delta F.
So we can say that for 1 unit of change of sigma f, like the standard deviation of f, there is
Delta S, not sigma. Delta. Sigma is not over here right now. Sigma will come later into the picture when we
mhm.
use this
Uh-huh.
in this formula.
Yeah, yeah, yeah.
Okay.
That is what I wanted to
Yeah,
ask.
yeah, please
Like
take it.
1 unit, that one only, with the correlation wala. Next one.
Okay. So your final, so this part when we
Yeah, yeah, yeah.
apply, what is the final interpretation of H star? Correct.
Like there is in the learning objective there was uh, and interpret the hedge ratio. So how do we interpret it?
See, we
That was.
interpreted that. We interpret. That is why I said when I gave this question, I have given some answers over here also. But when I gave this question, I asked you that this is your homework. We have already discussed. Please
Mhm.
do this after the class. So this is your homework. This homework will help you to interpret the hedge ratio. Okay. Basically,
Mhm.
this is the interpretation. See, how many units of futures you need to hedge 1 unit of spot. That is the interpretation.
Yeah, yeah, that is what I wanted to. I had a doubt in that. Like
Okay.
delta S is in the numerator and F is in the denominator. So
Correct.
generally, what we say in dy by dx for 1 unit change of x, 1 unit, how many units of y are changing?
Correct.
So,
Correct. Correct.
so don't you think similar should apply over here as well?
Exactly. And that is why I want this in the beginning only. That see, this is a counterintuitive. You might feel that the opposite should be the case, right?
Hmm.
X-axis, exactly that is why I said candidates think that delta F is the dependent one. So that's why delta F should go on the y-axis and delta S should go on the x-axis. But I'll tell you, there are two different processes that are going
No,
on.
no, 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 no. Not depending upon that. Upon
Mhm.
the formula,
Yeah,
see,
upon the
F
formula,
is.
though both are
Hmm.
same. Both are same. Depend to which what I am saying about the
Hmm.
axis and what you are saying about the dy dx part. They actually are
Yeah.
100% same in principle because dy
Hmm.
dx itself is derived on the choice of y versus x. So the choice is
Yeah.
very, very important.
Yes.
Okay, so why it is the case? I am telling you why you should have based on the definition, why you should not have delta f in the numerator or delta s in the or delta s in the denominator. Let me
Hmm.
just walk through that as well. And once you do the homework, this will be more clear to you. Now, see, there are two different processes. When I talk about
Hmm.
hedge ratio, I say it is the number of futures contract which are required per unit of spot to hedge. That is one
Ah,
definition.
got it.
So
Hmm.
based on that, you are absolutely right that it should be something like delta F over delta S or del F by del
Yeah.
F. Correct?
Yeah.
The problem is you are confusing between price and quantity.
Acha.
One is for price, the other is for quantity. So when we derive H star,
Hmm.
this regression is carried out between the price differences.
Okay.
Okay. And when we interpret H star, we are interpreting in terms of quantity. That is why.
Okay.
Okay.
Got it.
So to find out H star, we carry out a regression between price changes. Once you have found out H star, then
Hmm.
you interpret H star in terms of quantity. You are absolutely right. It will actually be del QF by del QS.
Hmm.
When I refer to del F del S, I will just write it down over here. That is why I highlight this point again and again in the class that there should be no confusion whatsoever. And yeah, okay, just a minute. Can I write it over here in this slide only? I'm writing it over
Yeah.
here.
Yeah.
Okay.
Yeah.
So I'm just saying that there are two things. One is del F over del S, and one is rate of change of S versus F. Now, based on
Ah.
the interpretation that we have seen, naturally naturally the intuition is that, okay, this should be correct.
Yeah.
Correct. But no, this F and S stand for price.
Okay.
But if you want to interpret it in this manner, it will actually be del QF over del QS. Then this is correct. Understood?
Okay. So we plot the prices to get the quantities required.
We plot the prices to get the value of H star first.
Hmm.
And then
Got
if
it.
we want to interpret H star in terms of quantity, we
Hmm.
interpret it like this. Then you can say del QF by del QS.
Hmm. Yeah.
That is that. Okay.
Okay.
So it is confusing and it can be a source of confusion. That's why we need to be very, very crystal clear about it. And that is why I always say pay attention to the mathematics part over here a little
Hmm.
bit. Because it can be easily ignored. In fact, you ask your fellow FRM candidates who are preparing, and if they have not done this kind of analysis, I can guarantee you can confuse them within minutes about this. Within minutes, and you will always get a wrong answer. And every time, even if you want, you can get an opposite answer every time. Also, what you want, you frame the question differently, you will get the opposite answer. Okay, so that's why it is important to be very, very clear on the mathematical side. And these questions that you guys ask in the class, which re-emphasize these concepts. See, because I told this only once or twice that this
Hmm.
it's always get confused in this. But once you ask this question once again, things become even more clear. Okay. So
Okay.
guys, even if, and this I'm telling to all of you, so even if the class is extending by say half an hour, 1 hour, sometimes 1.5 hours, this was supposed to end at 2 or at 1, sorry. So we should not get impatient, and we always need to make sure we need to acknowledge that of course we are learning something new. Although there are priorities, I can understand it's a Sunday, you might have planned something, but see, small sacrifices in the next few months will definitely, actually it will make your job easier only. Okay, Vedant is asking point in time snapshots of difference in spot and futures prices from the initial uh, uh, moment of observations are plotted here, right? Correct, correct, correct. X-axis futures price change from initial moment. Now, one more thing, Vedant, I can tell you over here. Now, there are two aspects. See, when we say point in time changes, let's say there is a base price. Okay. Just as an example, let's consider only one axis. Okay. For the sake of simplicity, because the same thing applies to the y axis also, or the x axis also. Let's consider spot price. So let's consider a base price. Now, delta x, when you say change from the initial moment of observation, technically it's not correct. Why? And again, it's a very, very valid question. Excellent question. Because if you plot delta S from the initial point all the time, then even after 5 years, you would be calculating the delta S from the observation 5 years back. Exactly. The moment of observation would also be rolling, which means that we can present it very simply also. We don't even need to go very technical about this. We can simply say delta is always the change in price from the previous period. So if we are plotting delta S on a daily basis, so whatever price was there on the previous day, and calculate the price change from the previous day as compared to today, that is your delta S. So every single time, exactly, delta S can simply be written as st minus st minus 1. Okay, so I'm just writing it once again. Delta S over here, excellent question you guys are asking. Delta S is equal to st minus st minus 1. Okay, not, because if I'm able to express this mathematically also, this idea, then the concept will be even more clear. Understood, Vedant, now? Not this, but this. Okay, great question. Okay, fine. Anything else from this chapter? Okay, fine. So thank you guys. Let's just end this session right now. Where is the, sorry. Okay, so we'll just end this session now. Thank you.